Hello there, and welcome. I'm so glad you found your way here tonight. Wherever you are right now, tucked into bed as the house grows quiet or settled into a favourite chair as the evening deepens around you, you are exactly where you need to be. Take a moment to get comfortable. Let your body find its position. Let your shoulders drop just a little. There's no hurry at all. Tonight we're going to explore one of the quietest revolutions in financial history. Not a crash, not a scandal, not a war or a panic, but a slow, almost invisible shift in how ordinary people invest their savings. A shift driven not by greed or fear, but by a single, humble idea that simplicity, practiced patiently and at low cost, might be the most powerful strategy of all. We'll follow that idea from the dusty lecture halls of academic finance to the retirement accounts of tens of millions of people around the world. And we'll ask a question that turns out to have a genuinely surprising answer. How did doing almost nothing beat almost everyone? If you drift away before we reach the end, that's perfectly fine. That's exactly what we're here for. So settle in, take a slow breath, and let's begin. To understand the revolution, we first need to understand the world it overturned. And that world was genuinely appealing in the way that confident, energetic worlds so often are. It had its own mythology, its own cast of celebrated characters, its own deeply held belief that the secrets of the market could be unlocked by the sufficiently clever and the sufficiently diligent. To understand why the index fund felt so radical when it arrived, we need to spend some time in the era that came before it, in the sunlit confidence of post-war American investing, when picking the right stocks felt less like gambling and more like a skill, a craft, almost an art form. The story begins, as so many American financial stories do, in the years after the Second World War. The war had ended in 1945, and America emerged from it in a condition unlike anything the country had previously experienced. Its factories were intact, its cities had not been bombed, its workforce was returning, young, energetic, hungry for the ordinary pleasures of peacetime life. Houses were being built at extraordinary speed, automobiles were rolling off assembly lines, babies were arriving in numbers that would define an entire generation. And the economy, after the long trauma of the Depression and the wartime sacrifice, was growing with a vigour that felt almost miraculous to people who remembered the breadlines of the 1930s. This prosperity was real, and it was spreading. The middle class was expanding in ways that would have been unimaginable a generation earlier. A factory worker could expect to own a home. A clerical worker could send children to college. The concept of the quote, _0, _. The employee who spent a career with a single employer, received a pension, and retired with security was not a fantasy, but a reasonable expectation for a significant portion of the workforce. America was becoming, for the first time in its history, a genuinely middle-class nation in its economic structure, and that transformation was changing what ordinary people needed from the financial system. It was in this context that the mutual fund began its long journey toward the centre of American financial life. Mutual funds were not new in the 1950s. The first ones had been created in the 1820s in the Netherlands, and American versions had existed since the 1920s. But the post-war boom gave them a new and far more important role. The idea behind a mutual fund was simple and genuinely useful. Instead of one investor buying shares in a single company, many investors pooled their money together. And a professional manager used that pool to buy shares in dozens or hundreds of companies. The individual investor got diversification, a spread of risk across many companies rather than dependence on any single one, without needing the capital or expertise to build a diversified portfolio from scratch. This was, on its face, a sensible arrangement. The small investor trying to navigate the New York Stock Exchange with a few hundred or a few $1,000s was genuinely at a disadvantage compared to institutions with access to research, to company management, to information that took time and resources to gather. A mutual fund levelled that playing field somewhat. You handed your money to professionals who spent every waking hour studying companies and industries and economic trends. In return, you paid them a fee, typically somewhere between 0.5% and 2% of your invested assets each year, and trusted that their expertise would more than compensate for that cost. It seemed entirely reasonable. You paid your accountant for their expertise in tax law. You paid your doctor for their expertise in medicine. Why wouldn't you pay a professional investor for their expertise in the market? The mutual fund industry grew steadily through the 1950s and accelerated through the 1960s, and as it grew, it developed something that all successful industries eventually develop: a culture. And the culture of the mutual fund industry in those decades was one of confident, almost exuberant faith in the power of skilled analysis to identify winning investments. The people who ran these funds were not merely managers. They were, in the popular imagination, and to a significant degree in their own self-understanding, experts of a particular and valuable kind. They read balance sheets the way musicians read scores. They understood industries the way engineers understood machinery. They had networks of contacts, subscriptions to specialized research services, years of accumulated experience. They were, in short, professionals, and in post-war America, professional expertise commanded genuine respect. The era produced its celebrities. In a period when financial journalism was expanding, more newspapers running stock tables, more magazines covering business, more radio programs discussing the market, the successful fund manager became a figure of public fascination. Names circulated in financial circles with the weight of reputation. A manager who had compounded returns at a remarkable rate over a period of years became a subject of admiring profiles, of investor letters quoted in the press, of the particular kind of quiet fame that attached to people who seemed to possess a rare and valuable ability. The market, after all, was a domain where skill and luck were deeply intertwined, and the person who seemed to have separated one from the other commanded real attention. The 1960s in particular produced what people in the industry would later call the go-go years, a period of extraordinary enthusiasm for aggressive growth investing, when a new generation of young fund managers abandoned the cautious, value-oriented approach of their predecessors and began chasing the fastest-growing companies in the fastest-growing industries. These managers moved quickly, traded frequently, concentrated their bets in the most promising sectors, and in the middle years of the decade, the results looked spectacular. Double-digit annual returns were not unusual. Some funds posted gains that seemed to validate the idea that the market's secrets really could be decoded by the sufficiently aggressive and the sufficiently clever. Investors responded. Money flowed into mutual funds in volumes that the industry had never seen before. The number of funds multiplied. New fund companies formed. The vocabulary of the era shifted in telling ways. Funds were described as, quote, one, the word, quote, two, carrying the implication that what was being offered was not merely investment but something more active, more skillful, more purposeful. You were not merely participating in the market's growth. You were paying for expertise that would identify the best opportunities, avoid the worst mistakes, and deliver returns that exceeded what the market as a whole would provide. The pitch was compelling, and tens of millions of Americans found it convincing. There was a word for what the industry was promising. That word was alpha. In the technical language of finance, alpha refers to the return that an investment generates above and beyond what could be explained by its exposure to general market movements. If the stock market as a whole rises by 10% in a given year, and your fund rises by 13%, 3 percentage points of that return, in theory, represents the value added by the manager's skill. Alpha was the product that the mutual fund industry was selling. It was the justification for the fees. It was the reason to choose active management over simply buying a basket of stocks and holding them. Alpha was, in essence, the claim that professional judgment could consistently add value over and above what the market itself would deliver. The word quote underscore 3 underscore in that last sentence turns out to be doing an enormous amount of work. Because even in those confident, optimistic years, even as money flowed into funds and managers enjoyed their celebrity, and investors marveled at the returns, there were quiet questions beginning to form at the edges of the picture. Not loud questions, not urgent ones, more like the faint hum of an unanswered problem that nobody had quite decided to take seriously yet. The questions were being asked, mostly, not on Wall Street, but in universities. Not by fund managers, but by economists. And the answers, when they came, would be profoundly uncomfortable for an industry that had built its entire edifice on the premise that expertise reliably produced superior outcomes. But the questions were slow to gather momentum, and in the meantime, the confidence of the era was real and contagious. Walking into a brokerage office in 1965 and asking a financial advisor which mutual fund you should own would have produced a conversation that felt entirely sensible and reassuring. The advisor would have talked about the fund's track record, about the manager's philosophy, about the sectors the fund favoured. There would have been charts, there would have been numbers, there would have been the comfortable language of expertise, of people who spent their professional lives doing something specialised, offering their services to people who had neither the time nor the training to do it themselves. This world had a genuine logic to it. The mutual fund, even in its most self-congratulatory form, represented a real improvement over the available alternatives for ordinary investors in the decades before it. The alternative, for most people, was either to leave their savings in a bank account earning minimal interest, to buy government bonds with modest returns, or to pick individual stocks themselves, an activity that required both capital and knowledge that most people simply did not have. Against those alternatives, the mutual fund, professionally managed, diversified, accessible with a relatively modest initial investment, was a genuine innovation. It gave ordinary people access to the equity market, to the long-term growth of the economy, in a way that had not previously been available to them. And the equity market, over the long run, had proven to be the most powerful wealth-building mechanism available to ordinary people. The stock market had recovered from the Depression, had grown through the war years, had expanded dramatically through the post-war boom. An investor who had simply held a diversified basket of American stocks through those decades would have seen their wealth multiply in ways that no savings account or bond portfolio could have matched. The promise of the mutual fund industry was built on this real foundation, that equities over time rewarded patient investors and that professional management could add something on top of that already powerful base. It is important to sit with that for a moment, because it is easy, knowing what we now know about what came next, to dismiss the active management era as pure illusion. It was not pure illusion. The market's long-term returns were real. The democratization of equity investing through mutual funds was a genuine benefit to millions of households. The managers who ran those funds were, in the main, serious and hard-working people who believed in what they were doing. The world they built had real value, what it did not have, what nobody had yet demonstrated convincingly, and what the coming decades would slowly and sometimes painfully reveal, was reliable, repeatable, cost-justified evidence that professional stock selection consistently produced better outcomes than simply owning the whole market. That question, whether alpha was real, whether expertise reliably justified its cost, was about to get a very careful examination. The people doing the examining were not fund managers or brokerage analysts. They were academics, sitting in university offices, working with data, applying statistical methods to questions that the investment industry had largely treated as settled. What they would find would be quiet, methodical, and, for the established order of Wall Street, deeply unsettling. But that story belongs to the next chapter. For now, let yourself rest in the confident world of post-war American investing, the world of the star manager and the performance fund, the world that believed expertise was purchasable and alpha was real. It was a world built on genuine optimism, on a real record of market growth, on the entirely understandable human preference for believing that the future could be navigated by those who studied it carefully enough. It was a world that made sense, and understanding why it made sense is the first step toward understanding why a single, humble, almost embarrassingly simple idea would eventually turn it inside out. Let your breathing slow. Let the images settle. The brokerage offices, the stock tables in the morning paper, the fund managers in their suits poring over balance sheets late into the evening. There is no urgency here, no crisis yet, nothing to resolve tonight. Just the quiet beginning of a story whose ending you already know is worth arriving at, slowly, in your own time. The questions began, as so many important questions do, not with a dramatic announcement or a public confrontation, but with a few quiet people sitting alone with data asking something that seemed almost impolite to ask. The investment industry had built an entire edifice on a particular assumption, that skilled professionals, applying rigorous analysis to the available information, could reliably identify which stocks would rise and which would fall, and that this skill, practiced consistently, would produce returns that justified the fees being charged. It was an assumption so widely shared, so deeply embedded in the culture of finance, that questioning it felt less like scientific inquiry and more like bad manners. but the questions kept forming anyway, and the people asking them were not contrarians for the sake of it, not agitators or ideologues with an agenda. They were, in the main, careful and methodical thinkers who simply looked at the available evidence and found it pointed somewhere uncomfortable. What they were really asking, stripped of its technical vocabulary, was this: are the people charging money for expertise actually delivering what they are charging for? It seems like the most natural question in the world. It is, in fact, the question that any sensible consumer asks before paying for any service. And yet in the world of investment management, in the confident decades of the post-war boom, it had been asked with surprising infrequency and answered with surprising imprecision. The intellectual roots of what would become the most serious challenge to active management stretch back further than most people realize. In 1900, a French mathematician named Louis Bachelier submitted a doctoral dissertation at the University of Paris that described stock price movements in probabilistic terms, treating the market as a system in which future price changes were essentially unpredictable from past ones. His work was largely ignored for half a century. Mathematics applied to financial markets was not yet considered a serious academic pursuit, but it planted a seed that would germinate slowly in the universities of post-war America. The seed found particularly fertile ground at the University of Chicago, which by the 1950s and 60s had become the most important center of financial economics in the world. Chicago economists were, as a group, deeply committed to the idea that markets were powerful information processing mechanisms, that when millions of buyers and sellers, each pursuing their own interests, traded with each other continuously, the resulting prices reflected an enormous aggregate of knowledge and expectation. This was not a mystical claim. It was a straightforward application of the idea that markets coordinate information efficiently, that the price of a stock at any given moment represented the collective judgment of everyone who had looked at that stock and decided what it was worth. From this starting point, a young economist named Eugene Farmer began, in the early 1960s, to develop what would eventually be called the efficient market hypothesis. Farmer was a careful, rigorous, somewhat combative thinker who approached financial questions with the same statistical toolkit he would have applied to any empirical problem. His doctoral dissertation examined the behavior of stock prices and found something that would prove deeply consequential, that price movements showed no meaningful pattern that could be exploited to predict future movements. Stocks did not trend reliably. Past performance did not predict future performance. The sequence of price changes looked, statistically, very much like what mathematicians called a random walk, a series of movements in which each step was independent of the last. Let's sit with that idea for a moment, because it is less intuitive than it sounds. A random walk does not mean that stock prices move arbitrarily, disconnected from any underlying reality. It means something more specific and more interesting than that. It means that price changes are unpredictable not because markets are irrational, but precisely because they are so efficient at incorporating new information. When a company announces unexpectedly strong earnings, its stock price rises, immediately, almost instantaneously, as traders absorb the news and bid the price up to a level that reflects the new information. The next price movement after that adjustment will be driven by the next piece of new information, which by definition cannot be known in advance. If it could be known in advance, it would already be reflected in the price. Think of it this way. Imagine a very large and very attentive crowd of people, each of whom has spent considerable time studying a particular company, its products, its competitors, its management, its finances. Each of them has an opinion about what the company's shares are worth. When they gather to trade, the price that emerges from their collective buying and selling represents, in aggregate, the distillation of all that analysis. For an individual analyst sitting outside that crowd to consistently identify prices that are wrong, stocks that the crowd has systematically mispriced, that analyst would need, on a regular basis, to possess information or analytical insight that the entire crowd lacks. This is not impossible. But it is, statistically speaking, very difficult to do reliably and repeatedly over long periods of time. Farmer formalized these ideas into a framework. In its weakest form, the efficient market hypothesis holds that current prices already reflect all information contained in past prices, meaning that studying charts and price patterns cannot yield a consistent edge. In its semi-strong form, It holds that prices reflect all publicly available information, meaning that analysing financial statements, reading industry reports, and following company news cannot yield a consistent edge either, because everyone else is doing the same analysis and the results are already in the price. In its strongest form, it holds that prices reflect even private information, which is a more controversial claim, and one that Farmer himself did not press too hard. The semi-strong form was the version that mattered most for the mutual fund debate, and it was the version for which Farmer and his colleagues began accumulating evidence with increasing statistical sophistication through the 1960s and 1970s. Their methods were not glamorous. They involved collecting large datasets of stock prices and fund returns, applying statistical tests, comparing results against benchmarks, and reporting what the numbers showed. It was painstaking, unglamorous work. But the results, aggregated across study after study, pointed consistently in the same direction. Most professional fund managers did not beat their benchmarks. Not over 1 year, not over 5 years, not over 10 years. When you adjusted for the risk that funds were taking, when you controlled for the fact that a manager could always boost returns by simply taking on more risk, the picture became even less flattering. And when you accounted for the fees that funds charged their investors, the case against active management became harder and harder to dismiss. The fees were not trivial. An annual management fee of 1.5% compounded over 20 years consumes a remarkable fraction of what would otherwise be an investor's return. We will come back to that mathematics in more detail later, because it is one of the most important and least intuitive aspects of the entire story. For now, simply note that fees are not just a line item. They are a permanent and compounding drag on every dollar an investor has entrusted to a fund. The work of Farmer and his colleagues was published in academic journals, cited in other academic papers, discussed at academic conferences. It did not, in the 1960s and early 1970s, make the front page of the Wall Street Journal. The investment industry was not, for the most part, reading the Journal of Finance, and even those within the industry who were aware of the academic research tended to respond to it with a mixture of skepticism and dismissal. Academic economists, the argument went, understood models and equations, but not the real world of markets. They looked at averages and missed the exceptions. Of course, the average manager underperformed, but the skilled manager, the truly exceptional one, still added value. The industry's case rested increasingly on the existence of outliers. This is a reasonable sounding response, and it deserves to be taken seriously rather than dismissed. It is certainly true that some managers, over some periods, do beat their benchmarks by meaningful margins. The question, and it is a genuinely hard question, is whether those managers are demonstrating skill or experiencing luck. In any large population of people making random decisions, a subset will produce impressive results purely by chance. If you flip a coin 10 times, the probability of getting 10 heads is small but not zero. If 1,000 people each flip a coin 10 times, several of them will get 10 heads. Does that mean those people are skilled coin flippers? Or does it mean that in a large enough sample, unlikely outcomes will occasionally occur? This is not merely a philosophical puzzle. It has practical implications. If a manager has beaten their benchmark for 5 consecutive years, you as an investor face a real decision. Is this evidence of genuine skill that will persist? Or is it evidence that you're looking at one of the lucky coin flippers whose run is unlikely to continue? The academic research, examined carefully, suggested that the answer was more often the latter than the industry liked to acknowledge. Studies that looked at the persistence of fund manager performance, that asked whether last year's top performers were more likely to be this year's top performers, found surprisingly little evidence of reliable persistence. The managers who had done well in one period did not systematically continue to do well in the next. There was a man, not an academic economist, but a professional investor turned writer, who translated these uncomfortable academic findings into language that ordinary people could understand. His name was Charles Ellis, and in 1975 he published an essay in the Financial Analyst Journal with the title The Loser's Game. It is one of the most important short pieces of financial writing of the 20th century, and its central metaphor deserves to be described carefully because it illuminates the index fund argument more clearly than almost anything else. Ellis borrowed the concept from a sports analyst named Simon Ramo, who had studied the difference between professional and amateur tennis. In professional tennis, Ellis noted, points are typically won. A player hits a shot of such skill and precision that their opponent simply cannot return it. The outcome of the match is determined by the quality of the winning shots. In amateur tennis, by contrast, points are typically lost. A player attempts something too ambitious, hits the ball into the net or out of bounds, and gives the point to their opponent. The outcome of the match is determined not by who plays brilliantly, but by who makes fewer mistakes. The two games look superficially similar, but are structurally opposite. Ellis argued that professional investing had undergone a transformation that made it much more like amateur tennis than most of its participants realized. In an earlier era, when relatively few sophisticated investors competed in the market, a sufficiently diligent analyst could gain a meaningful edge through research and insight. The competition was thin enough that skill reliably produced superior outcomes. But by the 1970s, the market was dominated by professional institutional investors, mutual funds, pension funds, insurance companies, bank trust departments, all of whom were applying sophisticated analysis to the same publicly available information. In this environment, the competition had become so intense that consistent outperformance was structurally very difficult to achieve. Most active managers were not competing against naive individuals who could be reliably outmaneuvered. They were competing against each other, which meant that for every manager who outperformed in a given period, another manager had to have underperformed by an equivalent amount. The aggregate of all active managers before fees had to equal the market return, because active managers collectively were the market. And then the fees came out, and after the fees came out, the average active manager, by mathematical necessity, underperformed the market. Not because they were incompetent, not because they were lazy, but because they were all competing so intensely against each other that excess returns were competed away, and the cost of that competition, in the form of management fees, trading costs, and administrative expenses, was borne by their investors. Ellis's essay circulated in the investment world and made some professionals deeply uncomfortable. It was making an argument that felt almost defeatist, that in a world of sophisticated, well-resourced competitors, the intelligent strategy was not to try harder, but to accept the market return at the lowest possible cost. It was, in a sense, an argument for humility as a financial strategy. And humility in the confident culture of Wall Street in the 1970s was not a fashionable virtue. Around the same time, a Princeton economist named Burton Malkiel published a book that would carry these ideas to a far wider audience. Quote 5, first published in 1973, became one of the best-selling investment books in American history. Malkiel wrote for the intelligent general reader rather than the academic specialist, and he did so with a directness and occasional humour that made the book genuinely readable. His central argument was built on the same foundations as Farmer's academic work, that stock prices followed something close to a random walk, that technical analysis of price patterns was essentially useless, that fundamental analysis of company finances was valuable, but was being done so thoroughly by so many professionals that it was very difficult to consistently identify prices that the market had gotten wrong. Malkiel's most famous formulation was, to the investment industry, deeply provocative. He suggested that a blindfolded chimpanzee throwing darts at the financial pages of a newspaper could select a portfolio that would do as well as one carefully chosen by expert analysts. This was not meant entirely literally. It was a rhetorical device to make a statistical point. But it landed in the investment world like a small, very precisely aimed stone. The image of the dart-throwing chimpanzee became shorthand for the entire academic critique of active management, and it infuriated many professionals who found it reductive and insulting. Their irritation was understandable, but, in a strict statistical sense, somewhat misplaced. Malkiel was not arguing that all stock analysis was worthless, or that professional investors were incompetent. He was making a narrower and more precise point, that in a highly competitive market where sophisticated professionals are continuously analysing the same information, it is extremely difficult to identify mispricings consistently enough, and by a large enough margin, to produce returns that exceed the market average after accounting for the costs of the analysis itself. The chimpanzee was not smarter than the analysts. The chimpanzee simply had no fees. There was a third figure whose contribution to this intellectual movement deserves mention, and it comes from a direction that might seem surprising. Paul Samuelson was perhaps the most celebrated American economist of the 20th century, a Nobel laureate, the author of the most widely used economics textbook in history, a figure of immense stature in both academic and policy circles. In 1974, Samuelson published an essay in the Journal of Portfolio Management that was, by the standards of academic economics, unusually direct and almost polemical in its intent. He examined the evidence on active fund management, found it deeply unpersuasive as a case for the value of professional stock selection, and called for the creation of an investment vehicle that would simply track a broad market index at minimal cost. The significance of Samuelson's essay is difficult to overstate in context. This was not a junior researcher publishing a speculative paper in an obscure journal. This was the most decorated economist in America, writing in a publication read by investment professionals, stating plainly that the evidence supported indexing over active management, and that if such a vehicle did not yet exist for ordinary investors, it ought to be created. He was, in a sense, writing the intellectual mandate for something that was, at almost exactly the same moment, being built, though he did not yet know by whom. The convergence of these intellectual threads, Farmer's academic rigour, Ellis's elegant competitive analysis, Malkiel's accessible popularisation, Samuelson's authoritative endorsement, created something important. It created a coherent, evidence-based critique of the investment industry's central premise, assembled over roughly 2 decades of careful work by people with no financial stake in the outcome. They were not trying to sell an alternative product. They were not short-selling mutual fund companies. They were simply examining the evidence and following it where it led. The evidence led somewhere that the industry found deeply uncomfortable and that most investors had not yet heard about because academic journals do not have large popular readerships, and the financial press, which depended in part on advertising from the investment industry, was not rushing to amplify findings that called the entire business model into question. The gap between what the data showed and what ordinary investors believed was, in the early 1970s, still very wide, and somewhere in that gap, a person was preparing to build something. He was not primarily a theorist. He was a practitioner, someone who had spent his career inside the industry, had thought deeply about its structure and its costs, and who had recently, through a combination of corporate politics and personal misfortune, been given the unusual freedom that comes from having nothing left to lose. But that story belongs to the next chapter. For now, let the ideas settle quietly. Let the image of the chimpanzee and the darts rest in the back of your mind without demanding resolution. Let the phrase quote, _6, dissolve gently into the background, like a question you don't need to answer tonight. The argument has been made. The evidence has been assembled. Someone is about to do something with it. Rest now. Let your breathing slow. The academic offices are quiet. The papers stacked neatly on the desks, the data processed, and the conclusions drawn. Outside the windows of those offices, the financial world continues its confident activity, largely unaware that the ground beneath it has quietly shifted. That is often how the most important changes begin, not with a bang, but with a series of careful, unglamorous observations that accumulate until they cannot be ignored. Sleep is close. Let the numbers and the theories drift softly past, like leaves on a slow current. There is nothing to resolve tonight. The story will be here when you return to it. Every revolution needs a human being at its centre. Ideas, however elegant, however carefully assembled from evidence and argument, do not build themselves into institutions. They require someone to carry them from the page into the world, to absorb the ridicule and the resistance, to remain steady when the easier path would be to abandon the experiment and return to the comfortable conventions of the existing order. The index fund had its ideas, Farmer's efficient markets, Ellis's loser's game, Malkiel's random walk, Samuelson's authoritative endorsement. What it needed was a person, and the person it got was, in many ways, the most unlikely kind of revolutionary. Not a disruptor who despised the establishment, but a man formed entirely within it, who had loved it, who had believed in it, and who had been cast out of it just long enough to see it clearly. His name was John Clifton Bogle, and he was born in May of 1929, roughly 5 months before the stock market crash that would define the decade of his childhood. The timing was not incidental to who he became. His family had been comfortable. His father was a business executive. His maternal grandfather had founded a successful Philadelphia company. But the Depression erased that comfort with the thoroughness that it erased so many things in those years. The Bogle family lost their savings. They moved repeatedly. Always to smaller quarters, always chasing a stability that kept receding. His parents' marriage did not survive the strain. Bogle and his twin brother were shuffled between relatives during some of the hardest years, absorbing as children do the anxiety and the uncertainty of the adults around them. What the depression instilled in John Bogle was not bitterness exactly, but something more useful, a permanent, bone-deep understanding that financial security was fragile, that costs mattered, that waste was not an abstraction but a real and consequential thing, and that the distance between comfort and hardship could be crossed with terrifying speed. These were not lessons he chose to learn. They were pressed into him by circumstance during the years when character is formed, and they would shape, decades later, every decision he made about how to build a company and what that company should stand for. He was a scholarship student at Blair Academy, a New Jersey preparatory school, where he worked in the dining hall to help cover his expenses. He was then a scholarship student at Princeton University, where he arrived in 1947 and found himself for the first time in an environment that asked him to think rigorously about things that genuinely interested him. He was hard-working, serious, perhaps slightly humorless, in the way that people who have had to work for everything tend to be, not dour, but earnest, with a conviction that effort and honesty and precision were not merely virtues but practical necessities. It was at Princeton that the seed of everything that followed was planted, though it would take nearly 3 decades to grow into anything visible. In his senior year, Bogle needed a topic for his undergraduate thesis, and he chose one that most of his classmates would have found obscure to the point of eccentricity, the mutual fund industry. It was a small and not particularly glamorous subject in 1951. Mutual funds existed and were growing, but they had not yet assumed the central role in American financial life that they would occupy by the 1970s and 80s. For a 21-year-old to choose this as his thesis subject suggests either unusual prescience or, more likely, the simple fact that he had stumbled across an article in Fortune magazine about the industry and found the questions it raised genuinely interesting. The research he did for that thesis would prove in retrospect almost eerily prophetic. Bogle read everything he could find about the mutual fund industry, its history, its structure, its performance record, its costs. And what he found, even in those early years before the academic critique of active management had fully developed, was an industry whose claims about its own value were not well supported by its actual results. Funds were expensive to own. Their returns, on average, lagged the market. Their managers were paid handsomely for outcomes that did not clearly justify the payment. He wrote in his thesis that mutual funds could make no claim to superiority over market indexes, and that the most important thing a fund company could do for its investors was to operate at the lowest possible cost. He was 21 years old. He had never managed $1 of other people's money. He had reached, through library research and careful thinking, conclusions that the most sophisticated academic economists of the next 2 decades would confirm through rigorous empirical study. This is not to suggest that Bogle was a genius who saw what others missed. The evidence for his conclusions was available to anyone who looked carefully at the data. What it does suggest is that he was, from the very beginning, someone who looked at the investment industry through a particular lens, not as an insider who benefited from its structure, but as an advocate for the person on the other side of the transaction, the investor who paid the fees and absorbed the underperformance. His Princeton thesis came to the attention of Walter Morgan, the founder of the Wellington Fund, one of the oldest and most respected mutual fund companies in America. Morgan hired the young Bogle directly out of Princeton in 1951, and for the next 2 decades, Bogle built his career at Wellington with the combination of intelligence, industry, and fierce ambition that had characterized everything he had done since childhood. He rose steadily through the organization, becoming Morgan's designated successor, eventually taking the reins of the company as its chief executive. By the early 1970s, he was running Wellington Management, responsible for several $1 billion in investor assets. He had arrived, and then he made a mistake, a significant one, committed not from malice or stupidity, but from the particular kind of overconfidence that afflicts intelligent people who have succeeded consistently and begun to believe that their judgment is more reliable than it perhaps is. The 1960s go-go era, with its enthusiasm for aggressive growth investing, had made Wellington's conservative balanced fund approach look stodgy and out of date. Assets were flowing toward the newer, flashier performance funds, and Wellington was losing market share. Bogle, eager to compete, engineered a merger in 1966 with a Boston investment firm called Thorndike, Doran, Payne and Lewis, a group of younger, more aggressive managers who ran a successful growth fund and seemed to represent exactly the kind of modern, performance-oriented approach that the era demanded. The merger made a certain competitive sense in the context of its time, but the chemistry between the two organizations was never good, and the relationship deteriorated through the early 1970s as the go-go era ended badly, growth stocks collapsed, and the performance funds that had seemed so brilliant in 1968 looked considerably less brilliant in 1973 and 1974. The partners Bogle had brought in to revitalize Wellington found themselves in the wreckage of the bear market with grievances against him, about strategy, about management style, about the direction of the company. In January of 1974, the Wellington Management Board voted to remove Bogle from his position as chief executive. He was 44 years old. He had given more than 2 decades of his professional life to the company. He was out. Sit with that for a moment. The man who would create the most consequential innovation in the history of retail investing was, at 44, a fired executive nursing a wound that was both professional and personal. He had not chosen to be a revolutionary. He had wanted to run Wellington. He had wanted the conventional success that he had worked toward his entire career. The firing did not transform him immediately into a visionary. It simply left him temporarily in a position of unusual freedom and unusual anger, with time to think and nothing left to protect. What happened next required a particular kind of resourcefulness. Bogle retained a technical connection to the Wellington funds, even after his removal from Wellington management, as the head of the fund's own board of directors, a position distinct from running the management company. It was a slender foothold, but he used it with creativity that his former colleagues did not anticipate. He proposed to the fund's board that the funds themselves should be restructured, that they should become, in effect, self-managed, operating independently of Wellington management and in service of their own shareholders rather than the profits of a management company. This was a genuinely radical proposal, unprecedented in the mutual fund industry. The board approved a modified version of the idea. In September of 1974, a new company was incorporated under the name Vanguard, a name Bogle chose from a book about the naval career of Admiral Horatio Nelson, specifically from a description of Nelson's flagship at the Battle of the Nile. The name suggested leading from the front, being first into danger, a certain martial sense of purpose that sat somewhat incongruously with the quiet, cost-obsessed philosophy the company would come to represent. But Bogle liked it, and Vanguard it was. The ownership structure that Bogle designed for Vanguard was, and remains, unique in the investment industry, and it is worth understanding clearly because it is the foundation upon which everything else he built rests. In a conventional mutual fund company, the management company is a separate for-profit entity that charges fees to the funds it manages. The fund's investors pay those fees. The management company's owners, its shareholders, often a publicly traded corporation, receive the profits. This means there is a structural tension built into every conventional mutual fund. The interests of the management company, which benefits from higher fees and larger assets, are not identical to the interests of the fund's investors, who benefit from lower fees. Bogle's structure eliminated this tension. At Vanguard, the funds themselves owned the management company. There were no outside owners extracting profit. The funds were operated at cost, meaning that any efficiencies achieved in running the business were passed directly back to investors in the form of lower fees, rather than being retained as profit by an owner class. It was a mutual organisation in the truest sense of the word. The investors and the company were structurally the same thing. Their interests were identical because they were identical entities. This structure was not merely philosophically elegant. It had direct, practical, compounding consequences for every dollar an investor placed with Vanguard. It meant that as the company grew and achieved economies of scale, the cost of investing fell. It meant that there was no incentive to add unnecessary services or products that generated revenue for the company at the expense of investors. It meant that the entire operation was oriented by its very structure toward a single purpose, delivering the market's returns to investors at the lowest possible cost. Every other consideration was secondary to that one. But the structure alone, however thoughtfully designed, was not yet the revolutionary idea. It was the vessel. The revolutionary idea was what Bogle decided to put in it. He had carried, since his Princeton thesis, the conviction that most active management failed to justify its costs. He had read Farmer and found the evidence compelling. He had read Ellis and found the loser's game argument persuasive. He had watched from inside the industry as decades of professional stock picking produced results that, in aggregate, lagged the simple alternative of owning the whole market. And now, running a new company with a unique structure that eliminated the profit motive for charging high fees, he was in a position to act on that conviction. In 1976, Vanguard launched the first index investment trust, the first mutual fund available to ordinary investors that did not attempt to pick stocks at all. The fund simply bought all 500 stocks in the Standard & Poor's 500 index in proportion to their market capitalization, and held them. It charged investors an annual fee of roughly 0.2%, a fraction of what actively managed funds were charging. It did not employ a team of analysts poring over balance sheets. It did not hold investment committee meetings to debate which sectors looked promising. It did not try to outperform the market. It simply tried to match the market at the lowest possible cost and then get out of the way. The reaction from the investment industry was swift, unified, and contemptuous. The fund was immediately nicknamed __7__Fidelity's chairman Edward Johnson declared that he could not believe that the great mass of investors would be satisfied with just receiving average returns. A widely circulated industry pamphlet called Indexing Un-American, an almost comically pointed choice of phrase that reveals how deeply the culture of active management had fused with a particular kind of national self-image. To accept average returns, the argument went, was to give up, to surrender, to abandon the American tradition of striving for excellence. The index fund was portrayed not merely as a bad investment strategy, but as a kind of moral failing. Bogle, to his credit, was not intimidated. He was also, in those early years, not overwhelmed with success. The first index investment trust raised $11 million in its initial offering, a sum so far below the $150 million that Bogle had hoped to raise that it was, by any normal measure, an embarrassing failure. The investment banks that had helped with the offering were disappointed. The press noted the underwhelming reception. $11 million was not nothing, but it was, in the context of an industry managing hundreds of billions, essentially nothing. It was a whisper in a very loud room, and yet Bogle did not close the fund. He did not declare it an experiment that had run its course, pivot to something more commercially appealing, and move on. He ran it. He kept the expenses as low as he could. He made the argument in letters and speeches and annual reports that the mathematics of low costs compounding over time were irrefutable, that patience would vindicate the approach, that the data were on his side even if the market flows were not. He was, in those early years, a man running a small, underfunded, widely mocked fund company in Valley Forge, Pennsylvania, sustained primarily by the conviction that he was right, and that eventually being right would be enough. The offices were famously Spartan. Bogle believed that every dollar spent on corporate amenities was a dollar that belonged to investors, and he ran Vanguard accordingly. There were no lavish headquarters, no expensive artwork on the walls, no first-class travel for executives. He referred to the culture he was building as the Vanguard way, a somewhat earnest phrase that reflected both his genuine idealism and his slightly Presbyterian conviction that austerity was not merely economical, but virtuous. His employees, who called themselves crew members in a nautical metaphor that extended the Admiral Nelson reference, seemed, by most accounts, to absorb something of his sense of mission. This was not just a job. It was, in a slightly unusual sense for a financial services company, a cause. What kept Bogle going in those early years of indifference and ridicule was partly temperament — he was constitutionally unsuited to giving up — and partly mathematics. He had run the numbers so many times, from so many angles, that the conclusion had become almost viscerally obvious to him. He would return to it constantly in different formulations for the rest of his life. If you invested $100 in an actively managed fund charging 1.5% per year, and the market returned 10% annually over 40 years, you would end up with roughly $4,400. If you invested that same $100 in an index fund charging 0.2% annually, with the same underlying market return, you would end up with roughly $6,700. The difference, more than $2,300 on an initial investment of $100, came entirely from the fee differential. The market had done the same thing in both cases. The manager had not added value. The fee had destroyed it. These numbers, extrapolated across millions of investors and trillions of dollars over decades, represented a transfer of wealth from investors to the investment management industry of almost incomprehensible scale. Bogle found this morally objectionable in a way that went beyond mere intellectual disagreement. He spoke about it, wrote about it, testified about it before Congress, included it in every book he wrote, mentioned it in interviews until journalists found it slightly repetitive. He was not modest about his conviction. He believed the investment management industry was, in aggregate, taking money from ordinary people in exchange for a service it was not reliably delivering, and he found this wrong in a way that did not diminish with the passage of time. But in 1976, and for most of the decade that followed, the world was not yet listening. The index fund sat in its Valley Forge offices, small and mocked and underfunded, while the rest of the industry went on as it had before. The transformation would come, but it would come slowly, built on the patient accumulation of evidence and the quiet passage of years. For now the seed was in the ground. Let that image rest with you for a moment. A small fund company in Pennsylvania, running a product that almost nobody wanted, managed by a man who had been fired from the career he had devoted his life to, sustained by nothing more substantial than a conviction that the mathematics were on his side. It is, in a quiet way, one of the more remarkable founding stories in American business history. Not a story of disruption and venture capital and explosive growth, but a story of patience and principle, and the particular stubbornness that distinguishes a person who believes something from a person who merely thinks it. The ridicule would continue for years. The assets would accumulate slowly, then less slowly, then with a momentum that nobody at the founding could have fully imagined. But that acceleration was still far in the future. For now, there was only the idea and the man and the small company built to carry the idea into the world, waiting for the world to be ready to receive it. Let your breathing slow. Let the image of those Spartan offices, that small staff, that $11 million settle gently. There is nothing urgent here. The story is patient. It knows how to wait. And so, tonight, can you? There is a particular kind of endurance that does not look like endurance from the outside. It does not announce itself. It does not dramatize its own difficulty. It simply continues, showing up each day, making the same argument with the same quiet conviction, tending something small in the faith that small things, given enough time and enough care, can become large ones. John Bogle, in the years following the launch of the first index investment trust, practiced this kind of endurance with a consistency that, in retrospect, seems almost implausible. He was running a company that the industry had dismissed, offering a product that investors were largely ignoring, in a market environment that seemed, for much of the late 1970s and early 1980s, almost perfectly designed to make his argument look unnecessary. The indifference was not malicious. It was, in many ways, simply a reflection of how human beings relate to ideas that challenge deeply held assumptions. The assumption that professional expertise in investing was valuable, that paying for skilled management was sensible, that the right fund manager could navigate markets better than a passive index. These beliefs were not held cynically by the people who held them. They were held genuinely, because they were consistent with how expertise worked in almost every other domain of human activity. You hired a skilled surgeon rather than letting an untrained person operate on you. You consulted an experienced lawyer rather than representing yourself in a complex legal matter. The extension of that logic to investment management felt natural, felt obvious, felt like common sense. And common sense, once established, resists revision with considerable force. The investment industry, meanwhile, had every incentive to keep that common sense in place. The active management business was enormously profitable, not for investors, but for the people running it. Fund companies collected fees regardless of whether their funds outperformed their benchmarks. A manager whose fund lagged the market by 2 percentage points annually still collected their management fee. The structure of the industry insulated it from the kind of accountability that other service businesses faced. A restaurant that consistently served mediocre food lost customers. A fund manager who consistently delivered mediocre returns in an era before the data were widely accessible or easily compared could retain assets for years through the simple mechanism of investor inertia and the persistent hope that better performance was just around the corner. Into this environment, Bogle continued to make his case. He wrote. He spoke. He published Vanguard's annual reports with an unusual degree of candor about what the company was doing and why, including detailed comparisons between Vanguard's costs and those of competitors. He appeared at investment conferences and said things that his audiences sometimes found uncomfortable and occasionally found offensive. He was not, by most accounts, a gentle or deferential debater. He believed he was right, and he said so with a directness that left little room for diplomatic softening. The investment industry, he argued repeatedly, was not in aggregate adding value for investors, it was extracting value from them. The sooner investors understood this, the better off they would be. The fund itself in those early years behaved exactly as Bogle had designed it to behave. It tracked the Standard & Poor's 500 index with reasonable fidelity. It charged its minimal fee. It did nothing dramatic. And in a market environment that rewarded drama, that celebrated the manager who made bold calls, who loaded up on the right sectors, who seemed to possess the gift of foresight, doing nothing dramatic was itself a kind of problem. The index fund had no story. It had no manager to profile, no investment thesis to explain, no concentrated bet to either admire or criticize. It was, by design, the absence of all those things, and in a financial media ecosystem built around the telling of investment stories, the absence of a story was nearly invisible. The late 1970s were difficult years for American investors of all persuasions. Inflation was running at rates that had not been seen in the post-war era, reaching double digits by the end of the decade. Interest rates were rising in response, which meant that bond prices were falling and stock valuations were under pressure. The market that had powered the post-war boom and justified the optimism of the go-go era was grinding through a prolonged period of poor real returns. In this environment, indexing the stock market felt to many investors less like a disciplined long-term strategy and more like a commitment to mediocrity in an already mediocre market. Why accept average stock market returns, the argument went, when average stock market returns were themselves disappointing? This was, from a purely logical standpoint, a confusion of two separate questions. The case for indexing was not a case for stock market returns being good in any given period. It was a case for the index approach delivering more of whatever the market delivered than active management did, net of costs. Even in a bad market, an index fund that captured the market's return at minimal cost was still likely to outperform the average actively managed fund that captured something less than the market's return at significant cost. The relative argument held regardless of whether absolute returns were strong or weak. But this distinction was not easy to communicate to an investor watching their portfolio stagnate in real terms and wondering whether a smarter manager might at least be losing less. Then came the 1980s bull market, and with it a new challenge to Bogle's argument, or rather, what appeared on the surface to be a new challenge but was, on examination, nothing of the sort. When Ronald Reagan took office in January of 1981 and Paul Volcker's Federal Reserve began bringing inflation under control through dramatically higher interest rates, the stage was being set, paradoxically, for one of the great bull markets in American history. As inflation fell and interest rates declined through the mid-1980s, stock valuations expanded. The market rose with a force and consistency that made the previous decade's stagnation feel like a bad dream. In this environment, active managers looked good. Many of them were posting impressive absolute returns, double-digit annual gains that seemed to validate the entire enterprise of professional stock selection. Investors who had been cautious through the difficult late 1970s began returning to equity mutual funds with enthusiasm, and the performance numbers that funds could show in their marketing materials were genuinely appealing. The case for paying an active manager seemed, in the glow of the bull market, self-evident. Things were going up, the managers were making money. Why change anything? What the bull market obscured, and what only became visible when you stepped back to look at the full picture, was that the index was going up faster than most active managers. The Standard & Poor's 500, rising on the back of falling interest rates and expanding corporate earnings and growing investor confidence, was outpacing the majority of actively managed funds, not by enormous margins in any single year, but with a consistency that, accumulated over the course of the decade, produced meaningful differences in investor outcomes. The average fund lagged its benchmark. After fees, the average fund lagged it by more. This was exactly what the academic research had predicted, and the bull market, by providing such strong absolute returns, was actually making the relative underperformance more visible, not less, for those who cared to look. But most investors were not looking at relative performance in those years. They were looking at their statements and seeing numbers that were growing, and numbers that were growing felt like success. The behavioral tendency to evaluate outcomes in absolute rather than relative terms is one of the most persistent and consequential biases in investment decision-making, and the 1980s bull market exploited it with particular efficiency. An investor whose actively managed fund returned 12% in a year when the index returned 14% felt, understandably, quite good about their 12%. The 2 percentage points they left on the table were real but invisible, buried in a counterfactual that required deliberate effort to construct. Vanguard's assets grew during this period, but modestly. The company added some new funds, bond index fund, a money market fund, some additional equity offerings, and the index fund itself accumulated a larger but still not dramatically large pool of assets. By the mid-1980s, the first index investment trust, renamed the Vanguard 500 Index Fund, had grown to several $100 million, a meaningful increase from its founding $11 million, but still a rounding error in the context of an industry managing trillions. The revolution was moving. Nobody would have described it as moving quickly. Bogle used these years to refine and sharpen his central argument. He returned, again and again, to a particular set of numbers that he believed were the most important and least understood in all of investing. They were the numbers around compounding costs, and they deserve to be examined carefully here, because they are the mathematical heart of everything the index fund movement was built on. The principle of compounding is familiar in its positive form. A sum of money invested at a consistent annual return grows exponentially over time, because each year's gains become the base on which the following year's gains are calculated. The famous example is a penny doubled every day for a month. By day 30, the result is over $5 million. The power of compounding is one of the first things taught in any introduction to personal finance, and it is genuinely remarkable. But compounding works in both directions. Costs compound too, and the compounding of costs is one of the most destructive forces in long-term investing. Consider two investors. Both invest $10,000. Both earn the same underlying market return of 10% per year for 30 years. The first investor's fund charges 1.5% annually in fees. The second investor's fund charges 0.2%. After 30 years, the first investor has approximately $152,000. The second investor has approximately $174,000. The difference, $22,000, came from a fee gap of just 1.3% annually. It came from nothing except the silent, invisible, compounding drag of costs paid year after year, each year slightly reducing the base on which the next year's returns would be calculated. Now scale that across a lifetime of retirement saving. An investor who contributes regularly to a retirement account over 40 years, paying active management fees rather than index fund fees, may arrive at retirement with a portfolio that is 30, 40, even 50% smaller than it would have been under the index approach, not because the market did anything different, but because a seemingly small annual cost difference, compounded over decades, consumed an enormous fraction of what would otherwise have been the investor's wealth. Bogle described this as the tyranny of compounding costs, and he meant the word tyranny quite seriously. He believed that most investors had no idea that this process was occurring, that the fee disclosures buried in fund prospectuses were not communicating the true long-term cost in a way that was meaningful to ordinary people, and that this information asymmetry amounted to a systematic transfer of wealth from investors to the investment management industry. He said all of this, at length and with considerable passion throughout the 1980s. He said it in speeches to financial advisors who sometimes received it politely and sometimes pushed back with irritation. He said it in his annual letters to Vanguard shareholders, which were notable in the mutual fund industry for their frankness and for the degree to which they engaged with questions of investment philosophy rather than simply reporting performance numbers. He said it in testimony before regulatory bodies. He said it in conversations with journalists who found him quotable, but occasionally exhausting in his single-mindedness. He was not a man who tired of his argument, because he did not experience it as an argument. He experienced it as arithmetic. The industry's response to Bogle's persistence evolved over the course of the decade. The early dismissal, Bogle's folly, the un-American surrender to mediocrity, gave way gradually to a more nuanced and more serious engagement. By the mid-1980s, it was no longer quite possible to pretend that the academic evidence against active management did not exist. Too many studies had been published. Too many economists of genuine distinction had endorsed the indexing approach. The conversation shifted subtly from whether the evidence was real to what it meant for investors and whether anything should be done about it. The industry's most effective counterargument was, and remains, the argument from selection. Yes, the average active manager underperforms, but not all managers are average. Some managers consistently outperform, not just for a year or two, which could be luck, but over longer periods that begin to suggest genuine skill. The smart investor's task under this argument is not to give up on active management, but to identify the genuinely skilled managers and invest with them, avoiding the mediocre majority. The index fund is for investors who cannot or will not do this work. For the discerning investor, active management remains a rational choice. This argument has genuine appeal, and it would be dishonest to dismiss it entirely. There have been, and continue to be, fund managers who have produced records of outperformance over long enough periods to make the luck explanation strained. The question, as always, is whether those managers can be reliably identified in advance, before their outperformance has occurred rather than after, and whether, once identified, their funds can be accessed at cost levels that preserve the advantage for investors. The academic evidence on both points is discouraging. The characteristics that predict future outperformance are weak and inconsistent. And the managers who do outperform tend, over time, to attract so much capital that further outperformance becomes harder, as the very size of the fund makes nimble positioning more difficult. Bogle found the selection argument unpersuasive, and he said so with characteristic bluntness. He pointed out that the search for the exceptional manager required the investor to make exactly the kind of judgment about future performance that the efficient market hypothesis suggested was very difficult to make reliably. You were in effect betting that you could identify the needle in the haystack, and that the needle would remain a needle after millions of other investors, also looking for needles, had piled into the same haystack. The simpler approach, he argued, was to own the haystack. Own the haystack! It was one of the more memorable formulations in a body of work that was not always memorable in its phrasing. Bogle was a powerful thinker, but not always an elegant writer, and it captured something essential about the philosophical shift that the index fund represented. The haystack metaphor acknowledged that identifying outperforming stocks in advance was genuinely difficult, that the market's collective judgment about prices was generally hard to consistently beat, and that the sensible response to this reality was not to give up on investing, but to invest in everything cheaply and let time do its work. As the 1980s gave way to the 1990s, Vanguard was growing. Still not dominant, still not the industry story, but growing. The assets under management were now in the tens of billions rather than the hundreds of millions. The index fund was no longer a curiosity that could be politely ignored. Other fund companies, watching Vanguard's slow but steady accumulation of assets, began to take quiet notice. Some began to offer their own index products, not out of philosophical conviction, but out of competitive necessity. If investors were going to put money in index funds, better that they put it in your index fund than in Vanguard's. This was, in a small way, the first sign of the transformation that was coming. The ridicule had faded. The dismissal had softened. The industry was beginning, slowly and somewhat reluctantly, to incorporate the index fund into its universe of acceptable products, not because it had been convinced by the argument, but because it had been worn down by the evidence and nudged by the market flows. The seed that Bogle had planted in 1976 was still small, but it was unambiguously alive, and underground, where seeds do their most important work before anyone can see it, the roots were spreading. Let that settle quietly. The patience of these years, the decade and a half of making the same argument to audiences that were largely unmoved, of running a small and mocked fund in a Spartan office in Pennsylvania, of watching the industry dismiss and then grudgingly acknowledge and then tentatively imitate. This patience was not passive. It was active, sustained, effortful patience, the kind that requires daily renewal. It is, in its own way, a remarkable thing to contemplate as you feel the day release its hold on you. The mathematics were patient too. Every year that passed was another year of compounding costs extracted from investors in actively managed funds. Another year in which the gap between what they were receiving and what a low-cost index investor was receiving widened silently, invisibly, with the relentless arithmetic of percentage points compounding on percentage points. The argument did not need to win any debate. It simply needed time, and time, as it always does, was passing. Let your breathing find its own rhythm now. The story is far from over, but this chapter of it, the long, unglamorous, essential chapter of persistence without reward, is complete. The foundation has been laid, the argument has been made and refined and made again. The company has survived its difficult early years and begun slowly to grow. Somewhere in the future of this story, the world will be ready to listen at scale. But that moment is not tonight's concern. Tonight's concern is simply to rest, to let the quieter virtues, patience, consistency, the willingness to be right without immediate recognition, settle into the background of your thoughts as sleep comes to find you. While Bogle tended his small company in Pennsylvania, making the same argument year after year to audiences that were slowly, incrementally beginning to shift their positions, a parallel process was unfolding in a world that had almost no direct contact with the investment industry's daily operations. It was unfolding in universities, in economics departments and business schools, in the offices of researchers who spent their days working with datasets rather than client portfolios, who measured success in published papers rather than asset flows, and who had no financial stake in whether their findings were commercially convenient or not. This independence was not incidental. It was, in fact, the source of the academic world's particular authority in this debate. The researchers had nothing to sell. They were simply, in the unglamorous tradition of empirical inquiry, trying to find out what was true. The work had begun, as we have already seen, with farmers' efficient market research and the accumulating statistical evidence that active managers did not, in aggregate, outperform their benchmarks after costs. But the academic case against active management did not stop with those early findings. It continued to develop through the 1970s and 1980s and into the 1990s, each new study adding another brick to a structure that was becoming, by the end of that period, very difficult to argue against on purely empirical grounds. The researchers were not coordinating their efforts in any organized way. They were working independently, in different institutions using different data sets and different methodologies, and arriving, with remarkable consistency, at similar conclusions. This convergence across independent lines of inquiry is precisely what gives a body of scientific evidence its weight. When people looking at the same question from different angles keep finding the same answer, the probability that the answer is correct increases substantially. One of the most important contributions of the academic research in this period was the careful documentation of what became known as survivorship bias, and it is worth pausing on this concept because it is both subtle and consequential, and because understanding it changes quite dramatically how one reads the mutual fund industry's performance record. The problem is this. At any given moment, the mutual funds that exist and have track records available for examination are not a representative sample of all the funds that have ever existed. They are specifically the funds that survived. The funds that performed poorly enough for long enough to be closed by their managers or merged into other funds, those funds have disappeared from the record. Their histories are gone, or at least not easily accessible to a researcher compiling performance data. This creates a systematic distortion. Imagine, as a thought experiment, that you are trying to evaluate the performance of a group of 10 fund managers over a 10-year period. At the beginning of the period, all 10 are running funds. By the end, 3 have been closed because their performance was so poor that investors left and the funds became unviable. You are now looking at a record of 7 managers. The 3 worst performers have vanished from the sample. The average performance of your remaining 7 looks considerably better than the average performance of all 10 would have looked, not because any individual manager improved, but simply because the worst outcomes have been removed from the calculation. This is survivorship bias, and in the mutual fund industry it operated at scale throughout the decades when the academic research was being conducted. Studies that used only currently existing funds to evaluate the industry's track record were systematically overstating how well active managers performed, because those studies were, without always realizing it, examining only the survivors. The funds that had been quietly closed after years of underperformance, the funds whose investors had paid fees and received poor returns and eventually given up and moved on, were not in the dataset. Their losses did not appear in the industry's reported averages. When researchers began correcting for survivorship bias, when they tracked down the records of closed and merged funds and included them in their analyses, the picture of active management's performance became noticeably less flattering. The number of funds that outperformed their benchmarks over long periods, already not impressive in the uncorrected data, became smaller. The magnitude of underperformance in the average fund, already meaningful, became larger. The industry's track record, examined honestly and completely, was worse than the industry's self-reported track record suggested. This was not a trivial finding. It meant that investors evaluating mutual funds based on the performance data available to them were working with information that systematically overstated the case for active management. The researchers who identified and corrected for survivorship bias were not making an accusation of deliberate deception. Fund companies were not hiding the records of their failed funds for cynical reasons. They were simply closing them, as any business closes products that do not work, and the resulting gaps in the historical record were a structural artifact of normal business practice rather than a conspiracy. But the effect on investor understanding was real regardless of intent, and the academic community, by identifying and quantifying this effect, was performing a genuine service, not to Vanguard or to any particular investment philosophy, but to the project of helping people understand what the data actually showed. The work on survivorship bias intersected with a broader stream of research on the persistence of fund manager performance. This question, whether last year's top-performing managers were likely to be this year's top-performing managers, was crucial to the industry's most important counter-argument, which was that even if the average manager underperformed, the skilled manager could be identified through their track record and rewarded with investor capital. If performance persisted reliably, this argument had real force. An investor who could identify managers with genuine skill, demonstrated through sustained outperformance, would have a rational basis for paying active management fees. The research on persistence was extensive and, taken in aggregate, discouraging for the active management case. Some studies found modest evidence of short-term persistence. Managers who had done well in one year were slightly more likely to do well in the following year than pure chance would predict. But this short-term effect was weak, was not consistent across different time periods and different market environments, and tended to diminish or disappear when examined over longer horizons. Over periods of 5 years, 10 years, or longer, the periods most relevant to investors saving for retirement, the evidence that past outperformance predicted future outperformance was very thin. The manager who had produced impressive returns for 3 years was not meaningfully more likely to produce impressive returns over the next decade than a randomly selected manager from the same category. There was an additional layer to the persistence problem that made it particularly challenging for investors trying to act on the selection argument. Even in cases where genuine skill existed and produced sustained outperformance for a period of years, the mechanism by which investors tried to capture that skill tended to destroy it. When a fund manager produced strong returns, investors flooded in. Assets under management grew, sometimes dramatically. And as assets grew, the manager's ability to deploy capital efficiently diminished. A manager running a $100 million fund could invest in small and mid-sized companies, could build concentrated positions in ideas they had high conviction about, could move in and out of positions without their own trading activity moving the market against them. A manager running $10 billion could do none of these things with the same effectiveness. The very success that attracted capital made the continuation of that success more difficult. This phenomenon, sometimes called the capacity constraint of active management, or more colloquially, the problem of asset bloat, meant that investors who arrived late to a successful fund, drawn by the track record that had already been established, were often buying into a strategy that could no longer be executed in the same way that had produced the track record. They were paying for a history they could not repeat, in a fund that had been fundamentally changed by its own success. The academic research documented this pattern with some consistency, finding that funds with rapidly growing assets tended to see their performance advantage erode over time. The needle, having attracted so much attention, had been buried under the weight of the very capital it had drawn to itself. Paul Samuelson's contribution to this literature deserves more careful attention than it sometimes receives, because his voice carried a particular kind of authority that most academic economists, however rigorous, could not match. Samuelson had won the Nobel Memorial Prize in Economic Sciences in 1970, the second year the prize was awarded, for work that had transformed economics from a largely qualitative discipline into a mathematically rigorous one. His textbook, Economics, first published in 1948, had sold millions of copies and trained generations of economists around the world. When Paul Samuelson wrote about something, people in the field listened with a degree of attention they might not have extended to a less decorated colleague. His 1974 essay in the Journal of Portfolio Management was titled Challenge to Judgment, and it was, by the standards of academic economics, almost startlingly direct in its conclusions. Samuelson reviewed the evidence on active fund management, the studies of performance persistence, the comparisons to benchmarks, the analysis of costs, and found it deeply unpersuasive as a case for the value of professional stock selection. He noted that the burden of proof lay with those who claimed that active management added value, and that the evidence they had produced did not meet that burden. He was not gentle about this conclusion. He wrote that it would be useful if at least one large mutual fund were to be established that simply tracked a market index, so that investors who accepted the logic of the evidence could act on it. The essay was written before Vanguard had launched its index fund. Bogle would read it and take note, though by then his own thinking had already converged on the same conclusion through his own path of reasoning. What Samuelson's essay represented in the context of the academic literature was a kind of capstone endorsement from the field's most authoritative figure. It was the equivalent of the most celebrated surgeon in the country, writing in a medical journal that a particular treatment did not work and should be replaced with something simpler and cheaper. The profession could not easily dismiss it. It could not attribute it to naivety or ignorance. It had to engage with it seriously. And engagement, even resistant engagement, is the first step toward change. The relationship between Samuelson's work and Bogle's was interesting and somewhat circular. Samuelson had provided intellectual validation for an approach that Bogle was, at almost exactly the same moment, putting into practice. Bogle would cite Samuelson's endorsement frequently in subsequent years, using the economist's authority to buttress the case he was making to investors and to regulators. Samuelson, in turn, became an admirer of what Bogle had built, writing later in his career that Bogle had done more for the ordinary investor than any other figure in the history of the investment industry. A remarkable statement from a man not given to hyperbole. Another academic contribution that deserves attention in this period came from William Sharpe, a Stanford economist who had developed the capital asset pricing model in the early 1960s, a framework for thinking about the relationship between risk and expected return that became one of the foundational tools of modern portfolio theory. Sharpe would later receive his own Nobel Prize for this work. But his contribution to the index fund debate was a simpler and in some ways more powerful piece of reasoning, published in 1991 under the title The Arithmetic of Active Management. Sharpe's argument was, as the title suggested, primarily mathematical, and its elegance lay in how little it required in terms of assumptions. He began from a single, almost trivially obvious observation. The aggregate of all investors must equal the market. If you add up every stock portfolio held by every investor in the world, you get the market portfolio. From this, a straightforward consequence follows. Before costs, the average actively managed dollar must earn the same return as the average passively managed dollar, because together they constitute the entire market. If passive investors earn the market return, and the average of passive and active together also equals the market return, then the average actively managed dollar must also earn the market return before costs. After costs, however, the situation changes. Passive investing is cheap. Active investing is expensive. It involves research, trading, and management fees that passive investing does not incur. Since both approaches earn the same return before costs, and active management incurs significantly higher costs, the average actively managed dollar must, by simple arithmetic, earn less than the average passively managed dollar after costs. This is not an empirical claim that could be refuted by a sufficiently large dataset. It is a mathematical identity, as certain as the statement that 2 + 2 = 4. In any universe where active and passive together constitute the market, passive investing must outperform active investing in aggregate, after costs, with absolute certainty. Sharpe's paper did not establish anything that the empirical researchers had not already found in the data. But it established it differently, not through the accumulation of evidence which could always in principle be questioned or reinterpreted, but through pure logical necessity. It closed off a line of retreat that the active management industry had often used against empirical studies, the argument that the studies were flawed, that the data were incomplete, that the methodology was imperfect. Against arithmetic, there is no methodology objection. The logic was either correct or it was not, and it was correct. The average active manager must underperform the average passive investor after costs, full stop. The gradual diffusion of these academic ideas into the broader investment conversation happened through several channels, each of which operated at a different speed and reached a different audience. The academic journals reached other academics and a small number of sophisticated institutional investors who read the research literature. The books, Malkiel's quote, 14. Ellis's expanded version of his Loser's Game essay and others that followed reached the educated general reader willing to spend an afternoon with a serious work of financial non-fiction. And then there was the financial press, which was the slowest of these channels to engage seriously with the academic critique, but which, by the mid to late 1980s, could no longer entirely ignore it. Articles began appearing in mainstream financial publications, not endorsements of indexing exactly, but engagements with the question, presentations of the debate between active and passive that gave the academic side a hearing alongside the industry's response. These articles rarely concluded that active management was simply wrong. The financial press depended on the investment industry for advertising revenue and was therefore structurally disinclined to bite the hand that fed it too vigorously. But the mere presentation of the debate, the acknowledgement that serious economists had raised serious questions about the value of active management, was itself a form of diffusion. Readers who had never heard of FEMA or Sharpe or survivorship bias were being introduced gently to ideas that had been circulating in academic circles for decades. The institutional investment world, the pension funds and endowments and insurance companies that managed far more money than the retail mutual fund industry, was a separate and in some ways more important arena for these ideas. Institutional investors had access to more detailed performance data than individual investors, employed sophisticated consultants who read the academic literature, and were accountable to boards and trustees who asked pointed questions about whether fees were justified by outcomes. In this environment, the academic evidence had sharper teeth. A pension fund trustee told by a consultant that the fund's actively managed equity portfolio had lagged its benchmark by 1.5 percentage points annually for the past decade, after fees, was in a different position than a retail investor who had never compared their fund's return to any benchmark at all. Some of the earliest and most significant adoptions of index investing occurred not among individual investors, but among institutional ones during the 1970s and into the 1980s. Wells Fargo Bank, Battery March Financial Management, and the American National Bank of Chicago were among the first institutions to create index-based strategies for their pension fund clients, doing so before Vanguard had even launched its retail product. These institutional index funds were not available to ordinary investors and received essentially no public attention, but they were an important early validation of the concept. Large, sophisticated institutions with access to the best available investment research were concluding that the index approach made sense for their clients. The institutional adoption moved quietly through the pension fund world over the course of the 1980s. Large corporate and public pension funds, managing the retirement savings of millions of workers, began allocating portions of their equity portfolios to index strategies. By the end of the decade, indexing had become, in the institutional world, not a radical position but a mainstream option. Consultants routinely recommended that pension funds maintain a core index allocation. The debate at the institutional level had shifted from whether to index to how much to index and which indices to use. This institutional legitimacy was important to the broader story for a reason that goes beyond the assets involved. Institutional adoption made it harder for the active management industry to maintain the position that indexing was a fringe approach suited only to investors too unsophisticated to identify good active managers. When the California Public Employees Retirement System, one of the largest pension funds in the world, was indexing a significant portion of its equity portfolio, the characterization of indexing as a surrender to mediocrity became difficult to sustain with a straight face. These were not unsophisticated investors. These were institutions advised by the most credentialed professionals in the field, making deliberate and informed choices based on the best available evidence. The academic machine, as we might call it, was doing something important and often underappreciated in these decades. It was not merely producing evidence that indexing worked, it was producing a coherent intellectual framework within which that evidence made sense. A way of thinking about markets, about competition, about the nature of information and the difficulty of consistently exploiting it, that gave investors a conceptual foundation for understanding why passive investing should outperform active investing on average. This framework mattered because human beings do not change their behavior simply in response to data. They change their behavior when they have both data and a story that explains the data, when the evidence and the explanation fit together in a way that feels true and complete. Farmers' efficient markets gave investors a reason to expect that stock prices were generally close to correct. Sharpe's arithmetic gave them a logical proof that active management must underperform in aggregate after costs. Ellis's loser's game gave them a vivid and memorable metaphor for why the competitive dynamics of institutional investing had made the search for alpha self-defeating. Malkiel's random walk gave them an accessible and somewhat entertaining account of the whole picture. Together, these contributions constituted not just a set of findings, but a worldview, a way of understanding the investment landscape that, once absorbed, made the decision to index feel not like a surrender, but like the only fully rational response to a clearly understood situation. By the end of the 1980s, that worldview had saturated the academic world, had made significant inroads in the institutional world, and was beginning, slowly, to seep into the consciousness of the educated retail investor. The seeping was slow. It would continue to be slow for another decade. But it was real, and it was irreversible. The ideas were in the world. They could not be put back. And somewhere in Valley Forge, Pennsylvania, a man who'd been called a fool for building his company around those ideas was watching the world, one study and one paper and one institutional allocation at a time, begin to catch up. Rest now. Let the images of those university offices, those datasets and journals and careful statistical analyses settle quietly into the background. There is something gently reassuring about the picture, the patient accumulation of evidence, the slow grinding of inquiry toward truth, the way ideas that are correct have a tendency, given enough time, to find their audience. It is not a fast process, it is rarely a dramatic one, but it is, in its unhurried way, reliable. Let your breathing slow. The argument has been built brick by careful brick in rooms that will never be famous, by people whose names most investors will never know. The work was real, the conclusions were sound, and they were waiting, with the patience of true things to be discovered by the world. The ideas had been built, the evidence had accumulated, the institutional world had quietly, methodically begun to act on what the research showed. And now, as the 1980s gave way to the 1990s, something began to shift in the broader investment landscape. Not dramatically, not all at once, but with the particular quality of change that comes when an idea whose time has arrived meets a market environment that cannot quite ignore it any longer. The index fund was moving from the margins towards something closer to the centre, not because the world had suddenly been persuaded by the argument, but because the argument had been sitting in plain sight long enough that more and more people were beginning to notice it was there. The 1990s were, in many ways, the most complicated decade in the history of index investing. Complicated because they were simultaneously the decade in which indexing achieved genuine credibility, and the decade in which the bull market made that credibility hardest to see clearly. The two things were happening at the same time in the same market, and they created a surface picture that was in some ways misleading about what was actually occurring beneath it. On the surface, the 1990s looked like a triumphant vindication of active management. Underneath, they were something quite different. The surface picture was this: from roughly 1982 through the end of the decade, and then continuing with extraordinary force through the 1990s, American equity markets rose with a consistency and a magnitude that had not been seen in the post-war era. The Dow Jones Industrial Average, which had spent much of the 1970s grinding sideways and had stood at around 800 in the summer of 1982, crossed 10,000 for the first time in March of 1999. That is an increase, over roughly 17 years, of more than 12 times. In percentage terms, it represented a compound annual return of somewhere around 15%, nearly half again as much as the long-run historical average for equities. In this environment, active fund managers were posting absolute returns that looked, to any investor who remembered the difficult 1970s, almost impossibly good. A fund returning 18% in a year, or 20%, or, during the peak years of the technology boom, considerably more, was a fund whose marketing materials wrote themselves. Investors who had sat out the bull market through caution or inertia watched these numbers and felt the particular discomfort of opportunity passing them by. Money flowed into equity mutual funds at rates that dwarfed anything the industry had previously experienced. The mutual fund in the 1990s became not merely a financial instrument but a cultural phenomenon, discussed at dinner parties, tracked in newspapers that had previously reserved their financial coverage for business readers, celebrated in magazine profiles of the managers who seemed to be printing money for their investors. But here is what the surface picture obscured. The Standard & Poor's 500 index, over the course of the 1990s, outperformed the majority of actively managed domestic equity funds. Not in every single year. There were years when the average active fund kept pace or even edged ahead, but over the decade as a whole, measured from beginning to end, most active managers delivered less to their investors than a simple, cheap index fund would have delivered. The bull market did not vindicate active management. It vindicated equities, which is a different thing entirely. The question was never whether stocks would rise. The question was whether, given that stocks were rising, active managers could capture more of that rise than a passive index net of their costs. And the answer, as it had been in every previous period the researchers had examined, was that most of them could not. The managers who did outperform during this period often did so by concentrating their portfolios in the sectors that were rising fastest: technology companies, internet companies, the emerging constellation of businesses that seemed to be building the infrastructure of a new economy. This concentration produced impressive short-term numbers and attracted enormous investor enthusiasm. But it also meant that these funds were taking on more risk than a broadly diversified index. They were making big bets on specific outcomes rather than owning everything and letting the market's overall growth carry them forward. The distinction between outperformance driven by skill and outperformance driven by concentrated risk-taking is crucial, and in the late 1990s, it was a distinction that very few investors were making. Vanguard, through all of this, continued to grow. The assets under management that had stood at a few $100 million in the early years of the index fund and had grown to the tens of billions through the 1980s were now moving into the hundreds of billions. The 500 index fund remained the flagship product, but the Vanguard lineup had expanded considerably. There were bond index funds, tracking the broad investment-grade bond market. There were international equity index funds, giving investors passive exposure to markets outside the United States. There were index funds focused on specific segments of the domestic market: small capitalization companies, value-oriented companies, growth-oriented companies. This expansion of the index universe reflected something important about how the concept had matured. In its original form, the index fund argument was specifically about the difficulty of picking individual stocks within a given market. The claim that the collective judgment of all market participants about which companies were most valuable was hard to consistently outguess. But the same logic applied, with some modifications, across different asset classes and different geographic markets. If the market for large American companies was efficient, making stock selection within that market unreliable, then similar arguments applied to bond selection, to international stock selection, to the allocation between different market segments. The index approach, extended across asset classes, offered investors the possibility of a fully diversified, broadly market-representing portfolio at minimal cost, not just for one slice of their holdings, but for all of them. This was a genuinely important development, because one of the standard objections to indexing had been that while it might make sense for large capitalization American stocks, where competition among analysts was most intense, it made less sense in other markets where information was less complete, and mispricings might be larger and more persistent. The development of index products across multiple asset classes invited investors to test this claim empirically. And when they did, they generally found that the cost advantage of indexing was sufficiently large across a wide range of markets to more than offset any theoretical advantage from active security selection in supposedly less efficient segments. Beyond Vanguard, other major fund companies were watching the asset flows and making their own calculations. Fidelity, the Boston-based giant that was in many ways Vanguard's most visible competitor, had built its brand almost entirely on the star manager model, on the cult of the exceptional stock picker, exemplified most vividly by Peter Lynch, who had run the Magellan Fund from 1977 to 1990 and produced a remarkable record of outperformance during that period. Lynch was the industry's most powerful counterargument to the index fund proposition, a living demonstration that exceptional active management was possible, that alpha was real, that the right manager could deliver something meaningfully better than the market average. Lynch's record was genuine and deserved its reputation, but it also illustrated, in ways that became clearer only in retrospect, some of the limitations of the star manager model. The Magellan Fund's performance during Lynch's tenure attracted enormous capital. By the time he retired, it was the largest mutual fund in the world, with assets of more than $14 billion. The fund that Lynch had been running as a nimble, concentrated portfolio of his highest conviction ideas had become something very different by the end. A vast collection of hundreds of positions that increasingly resembled, by necessity of its own size, the broad market index it was supposed to beat. And after Lynch's departure, the fund's performance became considerably more ordinary, reverting toward the benchmark that most actively managed funds, over time, tend to approach. Fidelity, observing Vanguard's growth and responding to investor demand, launched its own index fund offerings through the 1990s, quietly, without the philosophical conviction that animated Vanguard's approach, but practically because the business required it. Other large fund companies did the same. The indexing product had moved from being something that one eccentric company in Pennsylvania offered to something that every serious fund company needed to have in its lineup, if only to avoid the embarrassment of not having it when investors asked. This normalization was, in its own understated way, a significant victory for the idea. A product that the industry had dismissed as un-American in 1976 had become, 20 years later, a standard menu item that no competitive provider could afford to omit. The institutional world continued its quiet embrace of index strategies through the 1990s, and the scale of institutional indexing grew to levels that would have been unimaginable at the concept's founding. Large public pension funds, the California Public Employees Retirement System, the New York State Common Retirement Fund, the pension systems of states and municipalities across the country, were indexing substantial portions of their equity allocations. Corporate pension funds were doing the same. University endowments, under the influence of investment committees staffed by trustees who had read the academic literature, were incorporating index strategies into their asset allocation frameworks. The dollars involved were enormous, trillions in aggregate across all institutional investors. This institutional adoption had an interesting and somewhat paradoxical relationship with the retail market. Institutional investors, with their access to detailed performance data and sophisticated analytical resources, had reached conclusions about indexing that most retail investors had not yet reached. The people who knew the most about investment performance, who had the most rigorous access to the data and the most professional obligation to act on what it showed, were allocating heavily to index strategies. The people who knew the least, ordinary individuals making investment decisions based on fund marketing materials, financial media coverage, and the recommendations of advisors who were often compensated through commissions on actively managed products, were still for the most part in actively managed funds. The information gap between institutional and retail investing was producing dramatically different behavior in the two populations. It was against this background that one of the most important structural innovations in the history of index investing arrived, though its full significance would not be apparent for another decade. In January of 1993, the American Stock Exchange launched a new product called the Standard & Poor's Depository Receipt, known by its ticker symbol as the SPDR, and quickly nicknamed the Spider. The Spider was, in its basic economic substance, an index fund. It tracked the Standard & Poor's 500 index. It held all 500 stocks in proportion to their market capitalization. It charged a minimal annual fee. But it differed from a conventional mutual fund in one crucial structural respect. It traded on a stock exchange like a share of common stock throughout the trading day. A conventional mutual fund, including Vanguard's index fund, was priced once per day after the market closed. An investor who wanted to buy or sell shares in the fund submitted their order during the day and received the end-of-day price, whatever it turned out to be. The Spider could be bought and sold at any moment during the trading day, at a price that reflected the current market value of its underlying holdings, through any brokerage account that could trade stocks. This difference might seem technical, and perhaps not obviously important to a long-term investor who had no particular intention of trading in and out of their index fund holdings. And for that investor, the difference was indeed less important than it would become for other types of market participants. But the exchange-traded structure of the Spider opened the index concept to a broader universe of investors and institutions than the conventional mutual fund format had been able to reach. Institutional traders who wanted to gain or reduce market exposure quickly could do so through the Spider without the end-of-day pricing constraint. International investors who found the mutual fund structure unfamiliar or inaccessible could invest through a familiar stock exchange transaction. Investors who maintained brokerage accounts but did not have mutual fund accounts could access the index through the Spider without opening a new account type. The frictions that had limited the reach of index investing were, one by one, being reduced. The Spider was not an immediate mass-market phenomenon. In its early years, it was used primarily by institutional traders and sophisticated investors who valued its intraday liquidity for specific tactical purposes. The long-term retail investor saving for retirement was still more likely to hold a conventional mutual fund than an exchange-traded product. But the Spider's creation was the beginning of something. A new category of investment vehicle, the exchange-traded fund, that would eventually transform the investment landscape more completely than almost anyone in 1993 could have anticipated. Morgan Stanley, Barclays Global Investors, and other financial institutions took note of the Spider's modest success and began developing their own exchange-traded products. By the late 1990s, there were exchange-traded funds tracking not just the broad market but specific sectors: technology, healthcare, energy, financial services. There were exchange-traded funds tracking international markets, bond markets, specific factors like value and growth. The product category was expanding, still slowly relative to what would come later, but with a momentum that reflected genuine investor demand for low-cost, flexible, broadly diversified market exposure. Barclays Global Investors, in particular, invested heavily in building out its iShares line of exchange-traded funds through the late 1990s and into the early 2000s, creating a family of products that would eventually become the largest ETF provider in the world. The iShares launch was a recognition by one of the most sophisticated institutional investment managers in existence that the index and exchange-traded format represented the future of a significant portion of the investment industry. Not a niche product for a particular type of investor, but a broadly applicable and structurally superior vehicle for delivering market returns at low cost. Bogle himself was not enthusiastic about exchange-traded funds, and his skepticism is worth noting because it reflects a genuine and important tension within the index fund movement. Bogle's objection was not to the index concept, that of course he had championed for 2 decades. His objection was to the trading capability that the exchange-traded structure enabled. An investor who could buy and sell an index fund throughout the day, as easily as buying and selling a share of stock, might be tempted to do exactly that, to trade in and out based on short-term market movements, to use the index fund as a vehicle for speculation, rather than as the long-term, buy-and-hold instrument that Bogle believed it should be. The behavioral risks of excessive trading, buying high in enthusiasm and selling low in panic, were, in Bogle's view, at least as important as the structural benefits of low costs and the exchange-traded format by making trading frictionless, made those behavioral risks more acute. He was not wrong about the behavioral risk, and subsequent research would confirm that many investors in exchange-traded funds did trade them with a frequency that undermined the long-term returns the products were capable of delivering. The gap between what a fund returned and what the average investor in that fund actually received a quantity that researchers called the behavior gap, was often larger for exchange-traded funds than for conventional mutual funds, precisely because the ease of trading encouraged the kind of reactive, emotion-driven behavior that destroyed long-term returns. Bogle's instinct, as so often, was pointing towards something real, but the exchange-traded fund was also, for many investors, genuinely better than the alternative. An investor who held an exchange-traded index fund and did not trade it, who simply bought it and held it, as Bogle would have wished, received all the benefits of index investing with additional flexibility and often even lower cost than comparable mutual fund products. The vehicle was not the problem. The behavior was the problem. And behavior, unlike vehicle structure, was something that education and discipline and sensible financial advice could address. As the decade closed and the calendar turned toward 2000, the index fund had travelled a remarkable distance from the $11 million it had attracted at its launch in 1976. Vanguard was now managing hundreds of billions of dollars. The index concept had been validated by 2 decades of performance data, endorsed by the most credentialed economists in the world, adopted by the largest and most sophisticated institutional investors, extended across multiple asset classes, and translated into a new structural format that was beginning to reach investors who had never encountered a conventional mutual fund. The revolution was no longer a small, mocked experiment. It was a genuinely significant force in the investment landscape. And yet the largest chapter of the story was still ahead. The bull market of the 1990s, with its extraordinary absolute returns and its celebration of the star manager and the hot sector, had obscured the index fund's relative advantage in the minds of most retail investors. The data told one story, the headlines told another, and for as long as the bull market continued, the headlines were louder. What would change the balance? What would make the index fund's quiet arguments suddenly audible above the noise was not more data or more academic endorsement. It was something altogether less gentle. It was the market itself, turning on the very managers who had seemed in the late 90s glow to have mastered it. But that reckoning belongs to the next chapter. For now, let the decade settle around you. The long bull market, the slow institutional adoption, the quiet proliferation of index products, the first exchange-traded funds arriving in their modest way on the American Stock Exchange. Something was building. The current that had been moving slowly for 2 decades was beginning to feel the pull of a larger force. Not yet a flood, but no longer a trickle. Let your breath slow. Let the images of those rising markets and those growing fund families and those university offices full of careful researchers all soften at the edges. The story has been patient. It has waited a long time for the world to be ready, and the world, in its own unhurried way, was getting there. Sleep is close. Let it come. The bull market did not end quietly. It ended the way speculative manias tend to end, not with a gradual recognition that prices had exceeded reasonable valuations, not with an orderly adjustment back toward fundamental value, but with the particular violence of a conviction suddenly reversed, a collective belief that had seemed unshakable discovering almost overnight that it was made of something far more fragile than anyone had wanted to acknowledge. The 1990s had built something extraordinary in the American equity market, and what they had built was real in some respects and imaginary in others, and the painful work of the early 2000s was the slow, grinding process of separating one from the other. To understand what the dot-com crash revealed about active management, it helps to understand what the late 1990s had done to active management's incentives. The bull market had been broad and powerful through most of the decade, but in its final years it became increasingly concentrated. Technology companies, and specifically the emerging universe of internet-related businesses, began attracting a disproportionate share of investor enthusiasm and investor capital. Companies that had existed for only a few years, that had never earned a profit, that were in some cases generating only modest revenues, were being valued by the market at levels that required assumptions about future growth that, examined soberly, bordered on the fantastical. But in the atmosphere of the late 1990s, sobriety was not fashionable. The internet was going to change everything. Traditional measures of valuation were relics of an old economy that no longer applied. A new paradigm was in place. Active fund managers faced a particular and uncomfortable pressure in this environment. Their job, as they understood it, and as their investors understood it, was to outperform, to deliver returns that exceeded the benchmark. And in the late 1990s, the benchmark was being pulled upward with increasing force by technology and internet stocks. A manager who believed, on careful analysis, that many of these companies were wildly overvalued faced a dilemma that was genuinely difficult. If they avoided overvalued technology stocks and the stocks kept rising, their fund would lag the benchmark. Their investors would see their returns falling behind those of competitors who had loaded up on the very stocks the careful manager had avoided. Assets would flow out. In the performance-oriented world of retail fund management, sustained underperformance relative to benchmark, even principled, analytically justified underperformance, was an existential threat. The result, across a wide swathe of the active management industry, was a drift toward the very stocks that were driving the index higher. Managers who might in calmer times have maintained diversified, valuation-conscious portfolios found themselves, through competitive pressure and investor expectation, adding technology exposure. Some did so reluctantly, against their own better judgment, because the alternative was watching their funds empty as investors moved to competitors who were posting bigger numbers. Others did so enthusiastically, having genuinely absorbed the new paradigm thinking and concluded that the old valuation frameworks really were obsolete. Either way, the effect was the same. Actively managed equity funds across the industry accumulated substantial concentrations in the most expensive and most volatile segment of the market. The Standard & Poor's 500 index during this period was itself becoming heavily weighted toward technology, because the index weighted its components by market capitalization, meaning that larger companies represented a larger share of the index, and because technology companies were growing rapidly in market capitalization as their stock prices rose, the index was automatically, mechanically, increasing its technology exposure as prices rose. An index fund investor in 1999 owned considerably more technology stock as a percentage of their portfolio than an index fund investor had owned in 1995. The index was not immune to the bubble, it was participating in it. But here is the crucial distinction. The index was participating in the bubble in proportion to the market's own judgment about relative valuations. Active managers, under competitive pressure, were in many cases participating in the bubble at concentration levels that exceeded even the market's already elevated technology weighting. They were not merely reflecting the market's enthusiasm for technology. They were amplifying it, adding active bets on top of the passive exposure that the market structure was already providing. When the crash came, these amplified bets would produce amplified losses. The Nasdaq Composite Index, which was the primary home of technology and internet stocks, reached its peak on March 10, 2000, at a level of 5,148. From that peak it fell with a speed and severity that shocked even those who had worried about overvaluation. By October of 2002, the Nasdaq had fallen to approximately 1,114, a decline of roughly 78% from the peak. Individual technology stocks fell further. Companies that had been valued in the tens of billions of dollars became worth hundreds of millions, or nothing at all. As the business models that had seemed revolutionary turned out to be either genuinely flawed or simply not yet capable of generating the revenues their valuations had assumed, the actively managed funds that had concentrated in technology stocks fell with them. Some of the most celebrated funds of the late 90s, the funds whose managers had been profiled in magazine articles, whose returns had attracted enormous asset inflows during the boom years, suffered losses that were substantially worse than the broad market indices. An investor who had moved money from a diversified index fund into a technology-heavy growth fund in 1999, drawn by the recent performance numbers, discovered that they had arrived at the party just as it ended, holding a concentrated portfolio of overvalued assets that was about to lose a very large fraction of its value. The broad market indices fell too. Of course, the Standard & Poor's 500 declined roughly 49% from its peak in March 2000 to its trough in October 2002. This was a serious and painful bear market that hurt index fund investors genuinely and meaningfully. No honest account of the dot-com crash can pretend that passive investors emerged unscathed. They did not. But they emerged less scathed than most active investors, because they had not accumulated the concentrated technology bets that amplified losses in the actively managed funds. The index had fallen. The average active fund had fallen more. This relative outperformance of index funds during the crash was not merely a statistical finding buried in academic journals. It was visible in the actual account statements of actual investors, in the side-by-side comparisons that financial journalists began making as the extent of the damage became clear. For investors who had been in actively managed growth funds in 1999 and 2000, the experience was sometimes devastating. Losses of 50, 60, 70% in a single fund were not uncommon among the most aggressively managed portfolios. The contrast with what a simple index fund had delivered, painful losses, yes, but considerably less painful, was stark enough to be noticed even by investors who had not previously paid much attention to the active versus passive debate. The dot-com crash was, in this sense, a field demonstration of the index fund argument, not in the controlled conditions of an academic study, but in the real world, with real money, in real time. It did not prove that active management was always worse than indexing in all conditions. But it demonstrated, with particular clarity, one of the central risks of concentrated active management, that the competitive pressure to outperform in a rising market can lead managers to take on risks that are not fully visible until the market turns. The index fund's mechanical diversification, its refusal to make concentrated bets, its structural indifference to the performance pressures that warped active managers' incentives during the bubble, these were not bugs. They were features, and the crash revealed them as such. The recovery from the dot-com crash was slow and uneven. Markets stabilized through 2003 and began to rebuild, and as they did, the conversation in the investment world had shifted perceptibly. The tone of articles about mutual fund performance was different. The questions investors were asking their advisors were different. The experience of having watched celebrated active managers lose enormous amounts of money had created a skepticism that was harder to dislodge than any academic argument could have produced. Experience teaches in ways that data cannot, and the dot-com crash had been for a generation of investors a very expensive education. Vanguard's assets continued to grow through the early 2000s, and the pace of growth accelerated noticeably after the crash. Some of this reflected the general shift in sentiment away from aggressive growth strategies and toward more defensive and diversified approaches. Some of it reflected a genuine conversion, investors who had been burned by concentrated active management making a deliberate and considered choice to move toward index investing. And some of it reflected the simple mathematics of relative performance. In a period when actively managed funds had posted large losses, the index fund's smaller losses looked, relatively speaking, like a form of success. The recovery period also saw an acceleration in the growth of exchange-traded funds. The Spider, which had launched in 1993, had grown steadily through the late 90s, and the product category expanded rapidly in the post-crash years as investors and institutions sought low-cost, flexible, transparent vehicles for market exposure. Barclays Global Investors iShares family of exchange-traded products grew quickly, adding funds across a wide range of indices and asset classes. The exchange-traded fund, which had been a modest institutional tool in the 90s, was becoming a genuinely mainstream investment product for retail investors as well. And then, before the full lessons of the dot-com crash had been fully absorbed, before the generation of investors burned by technology stocks had entirely rebuilt their confidence, the financial system produced a second and in some ways more profound demonstration of the index fund argument. The financial crisis of 2008 was a different kind of crisis from the dot-com collapse, not a sector-specific bubble in overvalued growth stocks, but a systemic failure that originated in the mortgage market and spread through the interconnections of a financial system that had grown enormously complex, enormously leveraged, and dangerously dependent on the assumption that house prices would not fall substantially on a national scale. The story of the 2008 financial crisis has been told many times and in considerable detail elsewhere, and this is not the place to rehearse all of its causes and consequences. What matters for our purposes is what it revealed about active management and the claims that the investment industry had been making, explicitly and implicitly, about the value of professional expertise. Because 2008 was not merely a market crash. It was a failure of the industry's most sophisticated analytical tools, its most credentialed risk managers, its most elaborate mathematical models. The banks and funds that had created the mortgage-backed securities and collateralized debt obligations at the center of the crisis were not staffed by incompetent people. They were staffed by some of the most technically sophisticated financial professionals in the world. And those professionals had built systems that they did not fully understand, taken on risks they had not fully measured, and created a catastrophe whose dimensions they had not anticipated. For ordinary investors holding conventional mutual funds, 2008 was a year of severe losses. The Standard & Poor's 500 fell approximately 37% over the course of the year, the worst single calendar year decline since the 1930s. Investors who looked at their retirement account statements at the end of 2008 found portfolios that were dramatically smaller than they had been 12 months earlier. The experience was frightening, and for many people who were close to retirement, genuinely consequential in ways that affected their plans and their security. Active fund managers, in aggregate, did not protect their investors from these losses. This was, to many investors, the most disillusioning aspect of the crisis. Not that markets had fallen, which was painful but comprehensible, but that the professional expertise they had been paying for year after year in the form of management fees had provided essentially no protection against the fall. The average actively managed domestic equity fund lost approximately 39% in 2008, slightly more than the index. The average active fund in international equities lost more than the corresponding international index. Across asset classes and fund categories, the pattern was consistent. Active management did not defend investors against systemic market decline. The managers who were supposed to be navigating the market intelligently, adjusting portfolios in response to emerging risks, had largely stayed invested as the market fell and had fallen with it. There were exceptions. Managers who had seen the housing bubble clearly, had positioned their funds defensively, and had either avoided the worst losses or even profited from the decline. These managers became famous in the aftermath of the crisis, their foresight celebrated in books and articles and interviews, but the statistical picture, examined carefully, was familiar. In any sufficiently large population of active managers, some would make the right calls in any given crisis, not because of systematic skill that could be relied upon to repeat, but because in a large enough group some will be positioned well by whatever combination of analysis and fortune governs any individual outcome. The task of identifying in advance which managers would be among the lucky few was precisely the task that the academic evidence had consistently shown to be very difficult. Buying the manager who had called 2008 correctly was, as a systematic strategy, not reliably better than buying any other manager. What 2008 added to the conversation that the dot-com crash had begun was something specific about the nature of the expertise being sold. The dot-com crash had shown that active managers could take on concentrated risk during a bubble. 2008 showed that active managers could fail to navigate a systemic crisis even when that crisis was building slowly and visibly over several years. The argument that professional expertise was worth its cost rested at its core on the claim that professionals could see things that the market had not already priced, that they could identify opportunities and avoid dangers that were not visible to the passive investor who simply owned everything. 2008 demonstrated, painfully and at enormous scale, that the most sophisticated financial professionals in the world had not seen the danger clearly enough to avoid it. The aftermath of the 2008 crisis saw a surge in flows toward index funds that was, in magnitude and in speed, unlike anything the product category had previously experienced. Investors who had twice in a decade watched actively managed funds fall more than the index, who had twice paid fees for underperformance, who had twice had the comparison made visible and inescapable, were making different decisions. They were moving money out of actively managed funds and into index funds with a conviction and a scale that finally, definitively, moved the needle on the overall structure of the investment industry. The numbers were striking. In the years following the 2008 crisis, actively managed equity mutual funds experienced sustained net outflows, more money leaving those funds than entering them, for the first time in the industry's modern history. Index funds simultaneously were receiving net inflows of a scale that drove Vanguard's assets from hundreds of billions to trillions of dollars over the course of a decade. The passive share of the overall investment market, which had been a small fraction of total assets at the century's turn, grew steadily and then rapidly through the 2010s. crossing 50% of total domestic equity fund assets sometime in 2019, the same year that John Bogle died. The irony of that timing is almost too neat to be believed, and yet it is true. The man who had launched his revolution with $11 million in 1976, who had been called a fool and told he was un-American for believing that simplicity and low cost could outperform complexity and high cost, died in the same year that his approach crossed the threshold from minority position to majority of the market. He did not live to see it last long, but he lived to see it happen. There is something worth pausing on here, something that the two crashes together illuminate more clearly than either illuminated alone. The dot-com crash and the financial crisis were different in their causes, their mechanisms, and their precise effects on different types of investors. But they shared a common lesson, and it was the lesson that John Bogle had been articulating since his Princeton thesis in 1951, that Charles Ellis had captured in his Loser's Game essay, that Eugene Fama had demonstrated in his efficient market research. The lesson was not that markets were always rational, or that prices were always correct, or that professional investors were incompetent. The lesson was simpler and more profound than any of those things. It was that the costs of trying to beat the market, accumulated over time and compounded across a career of investing, were almost always larger than whatever benefits professional stock selection might provide. And that in a world where this was true, the intelligent response was not to try harder, or to pay more, or to find the exceptional manager. The intelligent response was to stop trying and to own everything, quietly, cheaply, and for a very long time. The two crashes made this lesson visible in a way that decades of academic research had not quite managed. Data can be argued with. Mathematical proofs can be found counterintuitive, but a decade in which investors watched their actively managed funds fall more than the index, paid fees throughout the decline, and arrived at recovery with less money than a simple index fund would have delivered. That experience settled into the investment consciousness in a way that was more durable than any published paper. It was not a comfortable lesson. It was not a lesson that anyone had wanted to learn at that price. But it was learned by millions of investors in a way that would shape their decisions for the rest of their financial lives. Let that settle now. Let the images of those difficult years, the technology stocks falling, the mortgage markets unravelling, the account statements arriving with their unwelcome numbers, rest quietly in the background. Where history stores the experiences it has finished with. The pain was real. The losses were real, but something was built from them, a clarity, a simplicity, a willingness to stop paying for complexity that did not deliver on its promises and to embrace instead the patient, unglamorous, remarkably effective discipline of owning everything and waiting. The worst is behind us in this story. What lies ahead is the world that these two reckoning built, a world in which the simple idea that Bogle had carried from his Princeton thesis to his Spartan offices in Valley Forge had finally, after decades of patient insistence, been recognized by the majority of the market as the most sensible approach available to the ordinary investor. It is a quieter world than the one that came before it, but quiet, as this whole story has been trying to tell us, is not the same as small. Rest now. Let your breathing slow. The crashes are over. The lesson has been learned. Sleep is waiting. Something happens when an idea survives two serious tests. It does not merely continue, it transforms. The index fund that emerged from the wreckage of the dot-com crash and the financial crisis was the same idea it had always been, built on the same mathematical foundations, serving the same fundamental purpose. But it was no longer a minority position in a debate that the mainstream had not quite engaged with seriously. It was increasingly the default assumption against which other approaches had to justify themselves. The burden of proof, which had rested on Bogle's shoulders for 3 decades as he argued that simplicity could outperform complexity, had shifted. Now it rested on the active manager, who had to explain with increasing specificity and decreasing patience from investors why their fees were worth paying and what evidence suggested their approach would work going forward when it had not worked clearly in the recent past. This shift in the burden of proof was not merely rhetorical. It had practical consequences for where money flowed, what products fund companies felt compelled to offer, and how the investment industry as a whole organized itself. And the vehicle through which these consequences were most visibly expressed was not the conventional mutual fund that Bogle had used to launch his revolution in 1976. It was the exchange-traded fund, that modest structural innovation that had arrived quietly in 1993 and had spent the intervening years growing slowly, extending its reach, and waiting for the moment when the investment world would be ready to embrace it at scale. That moment arrived in the years following 2008, and when it arrived with a force that transformed the investment landscape more rapidly and more completely than almost anyone had anticipated. The exchange-traded fund, which had been a useful institutional tool and a modestly popular retail product through the 1990s and early 2000s, became in the post-crisis decade something altogether different, a mass-market phenomenon, the primary vehicle through which tens of millions of new investors encountered the market for the first time, and the instrument through which the index fund revolution completed its transition from insurgency to dominance. To understand why the exchange-traded fund was so well suited to this moment, it helps to recall what had changed about the environment in which ordinary investors were making their decisions. The two crashes had done something important to investor psychology. Not simply frightened people away from equities, which was a temporary effect, but produced a more durable and more specific skepticism about the value of paying for active management. Investors who had survived both crashes were, as a group, more cost-conscious, more benchmark-aware, more inclined to ask what they were actually receiving for their fees. They were looking for something that was transparent, simple, cheap, and easy to understand. The exchange-traded fund offered all of these things, and it offered them through a format that was, for a growing segment of the investing population, more familiar and more accessible than the conventional mutual fund. The mechanics of the exchange-traded fund are worth describing carefully, because they are part of what made the product so well suited to the post-crisis environment. An exchange-traded fund is, at its core, a basket of securities, stocks, bonds, or other assets, that is created and managed according to a defined set of rules. In the case of an index exchange-traded fund, those rules specify that the fund will hold the securities in a particular index, in approximately the same proportions that those securities represent in the index, and will rebalance when the index changes its composition. This is the same basic approach as a conventional index mutual fund. What is different is how the fund is structured and traded. An exchange-traded fund issues shares that trade on a stock exchange throughout the day, just as shares of any individual company do. An investor who wants to buy shares in an exchange-traded fund places a buy order through their brokerage account at any point during the trading day and receives shares at the current market price. An investor who wants to sell does the same in reverse. There is no need to call a fund company, no minimum investment requirement beyond the price of a single share, no end-of-day pricing constraint. The transaction is identical from the investor's perspective to buying or selling a share of stock. This structural simplicity had important implications for accessibility. In the era of mutual funds, accessing a fund typically required opening an account with the fund company, meeting a minimum initial investment that was often several $1,000s, and navigating a process that was administratively more complex than a simple stock purchase. For investors who already maintained brokerage accounts, which by the early 2000s included a growing proportion of the investing population, adding an exchange-traded fund to their portfolio required no new account, no minimum investment beyond whatever a single share cost, and no process beyond placing a standard buy order. The friction that had limited the spread of index investing was being removed piece by piece. The cost advantages of exchange-traded funds, particularly index exchange-traded funds, were also meaningful. The largest and most established exchange-traded funds tracking broad market indices charged annual expenses that were, in many cases, lower even than comparable mutual fund index products. The Spider, tracking the Standard & Poor's 500, charged annual expenses of roughly 0.09% by the early 2000s. Vanguard's exchange-traded fund share class for its 500 index fund charged similarly minimal amounts. These were costs so small that they were, for practical purposes, invisible, a rounding error in any honest accounting of the factors that influenced an investor's long-term returns. The tax efficiency of exchange-traded funds was an additional advantage that mattered particularly to investors holding these products in taxable accounts rather than tax-advantaged retirement vehicles. The mechanism is somewhat technical, but its practical effect is straightforward. Because of the way exchange-traded funds create and redeem shares, through a process involving large institutional investors called authorized participants who exchange baskets of the underlying securities for fund shares rather than cash, the funds generally do not need to sell securities to meet investor redemptions. This means they rarely generate the capital gains distributions that conventional mutual funds sometimes produce when investors redeem shares and the fund must sell holdings to raise cash. For an investor in a taxable account, avoiding these distributions can meaningfully improve after-tax returns over time. These advantages – accessibility, low cost, tax efficiency, intraday tradability – combined in the post-crisis environment with a broader shift in investor sentiment to produce flows into exchange-traded funds that grew from substantial to extraordinary through the 2010s. BlackRock, which had acquired Barclays Global Investors and its iShares business in 2009, became the largest asset manager in the world, with iShares growing into the dominant exchange-traded fund franchise globally. Vanguard, which offered exchange-traded fund share classes alongside its conventional mutual fund products, continued its extraordinary growth. State Street Global Advisors, the creator of the original SPDR, maintained a significant presence. These three firms, BlackRock, Vanguard and State Street, came to be known, informally but accurately, as the Big Three of passive investing, and their combined assets under management grew to figures that would have been incomprehensible to anyone contemplating the investment landscape a generation earlier. The fee war that these three giants waged against each other through the 2010s was one of the more remarkable competitive episodes in the history of financial services, and its beneficiary was unambiguously the ordinary investor. As each firm sought to attract assets by offering lower costs than its competitors, expense ratios on broad market index products fell steadily and sometimes dramatically. An exchange-traded fund tracking the total United States stock market that might have charged 0.2% in the early 2000s might charge 0.03% a decade later. Products that had already seemed cheap became cheaper still. And in 2018, Fidelity, the Boston-based active management giant that had built its brand on the Star Manager model and had spent decades as Vanguard's most visible competitor, launched a series of index mutual funds with zero expense ratios, free, no annual fee whatsoever. The zero-fee index fund was, in one sense, a marketing gesture. Fidelity was offering a loss leader to attract investors who might also hold other, more profitable products. But it was also a genuine milestone, the logical endpoint of a fee compression that had been underway since Bogle had first argued that costs were the central variable in long-term investment outcomes. The industry that had charged investors 1.5%, 2%, sometimes more, for active management had been forced by competition and by investor awareness to offer its most basic product for nothing. The argument that costs mattered had been proven not just academically but commercially. In the most direct possible way, by the competitive dynamics of a market in which investors, finally armed with sufficient information to compare costs and outcomes, had voted with their feet. The democratization that the exchange-traded fund enabled was not only a story about cost, it was also a story about access, about the gradual removal of the barriers that had historically limited equity market participation to those with sufficient capital and sufficient financial sophistication to navigate the mutual fund system. The smartphone, arriving as a mass consumer device in the years after 2007, combined with the broader digitization of financial services to create a new generation of investment platforms that made equity investing accessible to people for whom it had previously been effectively inaccessible. Zero-commission trading platforms, which emerged in force through the middle years of the 2010s and which became universal across the major brokerage firms by 2019, removed the transaction cost that had previously made small, regular investments in exchange-traded funds uneconomical. An investor who wanted to invest $50 per month had previously faced the problem that a fixed trading commission of $7 or $10 represented a meaningful friction cost on each transaction. At zero commission, that friction disappeared. The investor could buy $50 of a total market index fund every month through an app on their phone without any cost beyond the minimal annual expense ratio of the fund itself. Fractional share investing, which several platforms introduced through the late 2010s, removed the final barrier of the share price itself, an exchange-traded fund share might cost $200, $300, or $400 more than a small investor wanted to deploy in a single transaction. Fractional shares allowed investors to buy a fraction of a share for whatever dollar amount they chose to invest, making it possible to build a diversified, low-cost, index-based portfolio with literally any amount of money. The minimum viable investment in the equity market, which had once been measured in thousands of dollars, had fallen to a single dollar. Or, in the case of zero-fee products, to effectively nothing at all. This democratization was genuinely meaningful in its social implications, even if its full significance was not always recognized in the financial press's coverage of the fee war and the asset flow statistics. The equity market had, for most of its history, been a mechanism through which capital accumulation compounded the advantages of those who already had capital. The high minimums, high costs, and institutional complexity of equity investing had created structural barriers that kept the market's long-term wealth-building power available primarily to those who were already wealthy enough to access it. The index fund, and particularly the low-cost, zero-minimum, zero-commission exchange-traded fund accessible through a smartphone, had substantially reduced those barriers. A 22-year-old beginning their working life with modest income could now invest small amounts regularly in a broadly diversified, extremely low-cost representation of the global equity market, and receive, net of costs, essentially the same return per dollar invested as the largest sovereign wealth fund or university endowment doing the same thing. This last point deserves emphasis because it represents something genuinely new in the history of financial markets. Large institutional investors have historically had advantages over small retail investors: better access to information, lower transaction costs, access to investment opportunities not available to individuals. Some of these advantages remain, but in the specific domain of broad market index investing, the small investor with a smartphone and a zero-commission brokerage account now receives essentially the same product, at essentially the same cost, as the institution with $10 billion. The expense ratio on a total market exchange-traded fund does not depend on how much you invest. The return per dollar is the same for the retail investor as for the institution. This equality of access, in a specific but important part of the investment universe, is historically unusual and represents one of the more quietly remarkable achievements of the index fund revolution. There was, however, a tension running through the democratization story that Bogle had identified early and continued to articulate with his characteristic directness until the end of his life. The exchange-traded fund's tradability, the feature that made it so accessible and so flexible, was also the feature that made it vulnerable to the behavioral errors that destroy long-term investment returns. An investor who checked their portfolio on their phone every day, who could sell their entire equity holding in 30 seconds, who was surrounded by a financial media ecosystem that treated short-term market movements as urgent and consequential, was an investor who faced constant temptation to do the thing that the evidence most clearly showed to be harmful, to react. The data on investor behavior in exchange-traded funds confirmed Bogle's concern. Studies of actual investor returns in exchange-traded funds consistently found that the average investor earned less than the fund itself earned, sometimes considerably less. The fund would have compounded at, say, 10% annually over a 5-year period, but the average investor in the fund, buying and selling at various points driven by market movements and emotional reactions, would have earned 7 or 8%. The gap, the behavior gap, represented real money, real losses, produced not by the fund's costs or its structure, but by the investor's own decisions. The low-cost vehicle had been available. The patient buy-and-hold discipline had not always accompanied it. This was not a counsel of despair, and Bogle did not mean it as one. It was an honest accounting of where the remaining challenge lay. Now that the structural and cost barriers to good investing had largely been removed, the remaining challenge was behavioral, not financial. It was about helping investors understand that the exchange-traded fund worked best when treated not as a trading instrument but as a long-term holding, bought regularly, held patiently, and checked as infrequently as one's temperament could manage. The fund itself was not the problem. The problem was the human tendency to do something, to respond to frightening headlines and falling prices, and the visceral discomfort of watching numbers go down, rather than the much more difficult and much more rewarding discipline of staying the course. Bowles' phrase for this discipline, quote 15, became one of the most repeated pieces of investment advice in the modern era, reproduced in books and articles and financial advisor presentations so often that it risked becoming a cliché. But clichés become clichés because they express something true, and quote 16 express something true about the single most important variable in the long-term investment outcome of any individual investor. The fund company had done its part, offered a low-cost, diversified, efficiently structured vehicle that delivered the market's return at minimal cost. The investor's part was simpler to describe and harder to execute. Own it, add to it regularly, and do not sell it when the market falls. The proliferation of exchange-traded fund products through the 2010s introduced a complication that Bogle found troubling, and that represents a genuine irony in the story of the index fund revolution. The original index fund had been built on the idea of simplicity: own everything, broadly, cheaply, and hold it forever. As the exchange-traded fund category grew, it expanded far beyond this original conception into an enormous and sometimes bewildering universe of increasingly specific and increasingly complex products. There were exchange-traded funds tracking every conceivable sector, every country, every investment factor, every commodity. Every thematic investment trend that a product designer could construct an index around. There were exchange-traded funds that used leverage to amplify market returns. There were inverse exchange-traded funds that profited when markets fell. There were exchange-traded funds covering cannabis companies, space exploration companies, artificial intelligence companies, companies selected by environmental criteria, companies selected by social criteria, companies selected by governance criteria. Many of these products shared the exchange-traded fund's structural advantages: low costs, tax efficiency, exchange tradability, while sharing almost nothing of the original index fund's philosophical simplicity. They were not passive vehicles for owning the broad market. They were active bets in passive clothing, expressing specific views about which sectors or themes or factors would outperform. Implemented through the efficient mechanism of the exchange-traded fund structure, an investor who bought a leveraged technology exchange-traded fund in the belief that technology stocks would continue to rise was not practicing the discipline of broad market indexing. They were speculating with a vehicle that made speculation cheap and easy and available at any hour of the day through any smartphone. Bogle found this proliferation troubling for reasons that went beyond aesthetic preference. He argued, consistently and with evidence, that the expansion of the exchange-traded fund universe into increasingly specific and increasingly tradable products was undermining the behavioral foundation on which the index fund's benefits rested. The original index fund worked because it was boring, because it gave investors nothing to trade, no thesis to act on, no exciting sector rotation to execute. The more interesting and tradable the exchange-traded fund became, the more it invited the kind of active, reactive behavior that the passive investing philosophy was supposed to replace. The vehicle was being used for purposes that were contrary to its own deepest logic. There was truth in this critique, and there was also a certain irony. The exchange-traded fund structure, which had been instrumental in bringing low-cost index investing to tens of millions of investors who would not otherwise have accessed it, had also created a platform for a new generation of complex, speculative niche products that bore little resemblance to Bogle's original simple vision. The revolution had produced children that the revolutionary did not entirely recognize as his own. This is perhaps the common fate of revolutions, to produce consequences that exceed and sometimes contradict the intentions of those who started them. But the core of what Bogle had built remained intact, and its scale was extraordinary. The basic product, a low-cost exchange-traded fund or mutual fund tracking the total market, held patiently over decades, was available to anyone with a phone and a brokerage account, at a cost so close to zero as to make the difference negligible, with no minimum investment, no barriers to entry, no expertise required beyond the simple discipline of continuing to invest and continuing to hold. The vision that had seemed utopian in 1976, democratized, low-cost, broadly diversified equity investing available to anyone who wanted it, had been substantially realized. Let that thought settle gently. The long journey from $11 million to trillions, from a mocked experiment in a Spartan, Pennsylvania office to the dominant form of equity investing in the world's largest capital market, from an idea that was called un-American to an idea that had made the American equity market more accessible to ordinary Americans than it had ever been in its history. It is a journey worth contemplating quietly, without hurry, letting its dimensions become real rather than merely numerical. The products are in place, the costs have fallen to near zero, the access is nearly universal. The argument has been settled, at least in the arena of practical market behaviour, if not in every academic seminar or every fund company boardroom. What remains is to reflect on what it all means, on the philosophy of simplicity that powered the revolution, on the questions it raised about markets and expertise, and the nature of investing itself, on the legacy of the man who carried the idea from a Princeton library to the centre of the investment world. But that reflection can wait until tomorrow, or the chapter after this one. Tonight, let the simple image of the exchange-traded fund rest in your mind. Not the complex leveraged version, not the sector-specific thematic version, but the original and simplest version. A fund that owns everything, charges almost nothing, and asks only that you be patient. It is not a dramatic image. It does not ask anything of you tonight. It simply exists, doing its quiet work, compounding in the background of 1,000 million accounts, indifferent to headlines and market movements and the noise that surrounds it on all sides. That indifference, it turns out, is not a weakness. It is the whole point. Sleep now. The market will be there in the morning doing what markets do, and somewhere in it, quietly, your small piece of everything will be doing what it does too. There is a particular kind of victory that does not look like victory from the inside. It does not announce itself with fanfare or arrive on a specific date that can be marked on a calendar. It accumulates, the way interest accumulates, slowly and then faster, until one day you look up and discover that the thing you were fighting for has become so ordinary, so taken for granted, so embedded in the normal functioning of the world, that the fight itself seems almost hard to remember. John Bogle spent the last years of his life watching this kind of victory unfold around him, not with the triumphant satisfaction of a general surveying a conquered field, but with the quiet, slightly bemused recognition of a man who had been right for so long that being right had stopped feeling like an achievement and had simply become the texture of the world. By the time Bogle died in January of 2019, at the age of 89, the scale of what the index fund movement had built was almost beyond comprehension in human terms. Vanguard alone was managing more than $5 trillion in assets, a number so large that it resists intuitive grasp, like the distance between stars. The total assets held in index mutual funds and exchange-traded funds globally had grown to somewhere in the range of $15 to $20 trillion, representing a share of the overall investment market that would have seemed fantastical to anyone present at the founding of the first index investment trust in 1976. The $11 million of that initial offering had become, through the compounding of a good idea over 4 decades, one of the largest transfers of investment methodology in the history of capital markets. The passive share of the United States domestic equity fund market crossed 50% sometime in the second half of 2019. The same year Bogle died, though slightly after his death in January. Whether he knew, in his final months, that the threshold was approaching is not recorded. But he had spent enough time with the trend lines to understand that it was coming, and the timing, whatever its symbolic weight, was in the context of a life's work entirely fitting. He had set out to change how ordinary people invested. He had succeeded. The majority of investment fund assets in the world's largest equity market were now managed according to the principle he had championed when the entire industry had called it folly. But what does it mean exactly for passive investing to have won? The question is worth examining carefully because the answer is more complicated and more interesting than a simple declaration of victory would suggest. The index fund's dominance in terms of asset flows and market share does not mean that active management has disappeared. There are still thousands of actively managed funds, still hundreds of billions of dollars in actively managed assets, still professional analysts spending their days studying company financials and trying to identify mispricings that the market has overlooked. The active management industry did not fold when passive crossed 50% of fund assets. It contracted in some areas significantly, but it persisted, it adapted, and in adapting it raised questions about the index fund's own future that were genuinely new and genuinely interesting. The most intellectually serious of these questions concerned the relationship between indexing and market efficiency, a relationship that turned out to be more paradoxical than the original efficient market hypothesis had quite anticipated. The efficient market hypothesis, remember, held that stock prices reflected all available information because sophisticated investors were constantly analyzing securities and trading on their conclusions, pushing prices toward their correct values in the process. This continuous price discovery was the mechanism through which markets became efficient, and it required, as a precondition, that there be a sufficient number of active, analytically engaged investors doing the work of price discovery. If passive investing grows large enough, some economists began to ask, does it undermine the very efficiency on which the case for passive investing rests? If fewer and fewer investors are doing the analytical work of evaluating securities, forming views about their intrinsic value, and trading on those views, will prices become less accurate reflections of underlying value? Will mispricings become larger and more persistent because there are fewer market participants actively working to identify and correct them? And if that happens, will the era of passive investing inadvertently create the conditions in which skilled active management becomes valuable again? Not because the average active manager is exceptional, but because the analytical vacuum created by passive dominance allows any sufficiently diligent analyst to find prices that are genuinely wrong. This is a serious question posed by serious economists, and it deserves a serious answer rather than a dismissal. The honest answer is that we do not yet fully know. The dominance of passive investing is recent enough that its effects on price discovery are still being studied and debated. What the available evidence suggests, tentatively, is that markets have remained reasonably efficient even as passive investing has grown, that the active managers who remain, now competing against each other in a smaller pool, are generally sufficiently sophisticated and sufficiently well-resourced to maintain the price discovery function without requiring the full participation of the passive segment. But this is an area of genuine uncertainty, and intellectual honesty requires acknowledging it rather than pretending the question does not exist. A related concern involves the concentration of ownership that the passive revolution has produced. The three largest passive fund providers, BlackRock, Vanguard, and State Street, are collectively the largest shareholders in the majority of large American public companies. When you own index funds from any of these providers, you own, through them, meaningful stakes in essentially every major corporation in the American economy. The big three together own, in aggregate, something in the range of 20 to 25% of the shares of the typical Standard & Poor's 500 company. This concentration of ownership in the hands of a small number of institutions raises questions about corporate governance, about the exercise of shareholder power, and about the relationship between passive ownership and the competitive dynamics between the companies the funds hold. The corporate governance question is worth pausing on because it cuts in an interesting direction. A conventional active fund manager who is unhappy with the management of a company they own has two options. They can vote their shares against management at shareholder meetings, or they can sell the shares. The passive index fund has only one option. It must hold the shares. Because selling them would mean deviating from the index. The passive fund cannot express its dissatisfaction by selling. It can only express it through voting. This means that the governance quality of the large passive fund providers, how thoughtfully they exercise their shareholder votes, how effectively they engage with the management of the companies they own, matters enormously because their votes cannot be supplemented by the discipline of exit. Vanguard, BlackRock, and State Street have all, in response to this recognition, expanded their internal stewardship functions. The teams responsible for engaging with company management and exercising proxy votes on behalf of fund shareholders. Whether these stewardship efforts are sufficient, whether they can substitute effectively for the governance discipline that active ownership provides, is debated. Some argue that passive owners are structurally too large and too diversified to engage meaningfully with any individual company, that the economics of the situation make deep governance engagement unviable at scale. Others argue that the large passive providers, precisely because of their permanent ownership position, have stronger incentives to care about long-term corporate behavior than active managers who may sell their positions at any moment. The debate is ongoing, and its resolution matters not just for investment theory, but for the functioning of the corporate sector of the economy. These complications and questions are real, and they are part of the honest accounting of what the index fund revolution has produced. But they should not obscure something more fundamental, which is the magnitude of the benefit that the revolution has delivered to ordinary investors over the course of the past 5 decades. The estimates of this benefit are large enough to be genuinely staggering, and they deserve to be stated clearly. John Bogle estimated in various formulations over the years that the fee reduction that index investing had forced, both directly through the growth of index funds and indirectly through the competitive pressure that forced active managers to lower their fees in response, had saved American investors hundreds of billions of dollars. Some estimates, accounting for the full compounding effect of fee savings over decades, ran into the trillions. These are not precise numbers. The counterfactual of a world without index funds is not observable. Only estimable, but even the conservative versions of the calculation represent a transfer of wealth from the investment management industry to ordinary investors of historic proportions. Think about what that means in human terms. A teacher or a nurse or a factory worker who began contributing to a 401k in the 1980s, who chose index funds over actively managed alternatives, who held those funds through the dot-com crash and the financial crisis and the subsequent recovery, arrived at retirement with a portfolio that was meaningfully larger than the portfolio of an equivalent investor in equivalent actively managed funds, not by a little. By amounts that, compounded over 30 or 40 years of saving, represented the difference between financial security and financial anxiety, between choices and constraints, between the retirement you planned for and the retirement you had to accept. The mathematics of fee compression, operating silently over decades, produced outcomes that mattered in the most immediate and personal ways. Bogle understood this, and it was the source of his lifelong passion for the cause in a way that went beyond intellectual conviction into something more like moral urgency. He did not experience the index fund as a financial product. He experienced it as an instrument of justice, a correction of a structural unfairness in which an industry collected fees for a service that it was not, in aggregate, reliably delivering, at the expense of the ordinary people who were trying to save for their futures. His anger at this arrangement never fully cooled. Even in his 80s, giving speeches and writing books and making public statements, he retained the evangelical quality of someone who believed he was fighting for something that genuinely mattered to the lives of real people. And he was right. There is a line of reflection that the index fund revolution invites, and it is worth following it gently here. In the quiet space of this late hour, the index fund won because it was based on a true idea, not a complex idea, not a sophisticated idea requiring advanced mathematics or specialized knowledge. A simple idea, almost embarrassingly simple once you have heard it stated clearly. The idea is that markets, in aggregate, are very good at incorporating information into prices, that this aggregate wisdom is very hard to consistently outperform, that the costs of trying to outperform are real, compounding, and largely invisible to the investors bearing them, and that the sensible response to these facts is to stop trying to outperform, accept the market's return, and minimize the costs of doing so. What is interesting about this idea, examined carefully, is that it is fundamentally an argument for humility. Not for giving up, not for pessimism, not for a low view of human capability, but for a specific and important kind of intellectual humility about the limits of what individual judgment can reliably accomplish in a particular domain. The market, the argument goes, is smarter than any individual participant because it incorporates the judgments of all participants simultaneously. To believe that you can consistently outguess the aggregate is to believe that your individual judgment is reliably better than the collective judgment of millions of informed participants. This is a belief that is occasionally true in specific cases and specific periods. It is rarely true consistently, over long periods, and net of costs. This is a philosophical position as much as a financial one, and it has resonances that extend beyond the specific domain of stock market investing. The recognition that collective information processing systems often outperform individual experts, that the wisdom of crowds, properly organized, frequently beats the wisdom of the most credentialed individual, is a theme that appears in many fields. In medicine, systematic evidence from well-designed studies typically outperforms the clinical intuitions of even experienced practitioners. In weather forecasting, statistical models often outperform individual forecasters. In a variety of prediction tasks, aggregating many independent forecasts produces results that exceed those of any single forecaster. The efficient market hypothesis is, in this broader context, a specific application of a general principle about the relative reliability of aggregated versus individual judgment in complex systems with many participants. Bogle never framed his argument in quite these terms. He was a practical man who preferred to make his case through arithmetic rather than philosophy. But the philosophical depth of what he was arguing is real. He was saying, in effect, that the proper response to complexity is not more complex analysis but simpler structures. That the proper response to uncertainty is not more confident predictions but lower cost acceptance of uncertainty's outcomes. That in a world where the future is genuinely hard to predict, the investor who spends the least on prediction will, over time, do better than the investor who spends the most. This is a counterintuitive conclusion in a culture that tends to believe that more effort, more expertise, and more sophisticated analysis will always produce better outcomes. But the evidence, examined honestly, supports it. The legacy of what Bogle built is visible in the structures of the investment world today in ways that are so normalized as to be nearly invisible. The idea that a retail investor should compare their fund's returns to a relevant benchmark is now standard practice, so commonplace that it is hard to remember that for most of the mutual fund industry's history, this comparison was rarely made systematically. The idea that expense ratios are a critical variable in fund selection, that a low-cost fund of a given type is, all else equal, preferable to a high-cost fund of the same type, is now taught in every personal finance course, included in every financial advisor's presentation, stated as a matter of course in publications aimed at ordinary investors. The idea that a broadly diversified, low-cost, passively managed portfolio is a reasonable and respectable choice for a long-term investor, that choosing not to pick stocks or chase managers is not a surrender, but a sophisticated and evidence-based strategy, is now so widely accepted that stating it generates no controversy at all. None of these ideas were obvious or uncontested when Bogle began his work. All of them were fought over, dismissed, ridiculed, and resisted by an industry that had powerful financial incentives to maintain the alternative view. The fact that they are now ordinary, taken-for-granted elements of mainstream investment thinking represents the full depth of the revolution, not merely in the assets that flow into index funds, but in the conceptual framework through which investment decisions are now made and evaluated. Bogle himself was not uncritical of what the revolution had produced. In the final years of his life, he expressed concerns about the directions in which the exchange-traded fund had taken the indexing concept, the proliferation of complex sector-specific leverage-using products that bore his original idea's name but not its spirit. He worried about the concentration of the investment industry in the hands of 3 enormous passive providers and about what that concentration meant for the health of capital markets and the governance of public companies. He worried that the message of patient, long-term, low-cost investing was being lost in the noise of a financial media ecosystem that celebrated trading and strategy and excitement over the quiet discipline of staying the course. He was, to the end, more interested in what remained to be done than in celebrating what had already been accomplished. This critical quality, the refusal to let the revolution's success become an excuse for complacency about the revolution's unfinished business, was characteristic of Bogle in a way that seems, in retrospect, inseparable from his effectiveness as a reformer. He was sustained not by the satisfaction of being right, though he clearly was satisfied to have been right, but by the ongoing sense that investors were still not being treated as well as they deserved to be, that the industry still had incentives that were not fully aligned with investor interests, that the work of building a fair and cost-effective investment system was genuinely never finished. This kept him writing and speaking and arguing well into his 80s, through a heart condition that had required a transplant decades earlier, and that he managed with the same matter-of-fact pragmatism he brought to everything else. When he died, the tributes were extensive and genuine. Warren Buffett, who had for decades recommended low-cost index funds to ordinary investors and had famously included a 10-year bet in favor of index funds against a basket of hedge funds, a bet he won decisively, said that Bogle had done more for the ordinary investor than any other individual in American history. Paul Samuelson, who had called for the creation of the index fund in 1974 and who had lived to see his call answered beyond anything he could have imagined, described Bogle's contribution as historic. The financial press produced retrospectives that traced the journey from the $11 million of the initial offering to the trillions under management, from the ridicule of the industry to the grudging adoption of indexing by every major fund company, from the academic argument to the behavioral revolution in how ordinary Americans thought about their savings. What these tributes captured, in aggregate, was the portrait of a man whose most important contribution was not a financial innovation in the narrow sense, not a new instrument or a new strategy or a new mathematical insight, but a sustained, decades-long argument for a set of values that the investment industry had consistently failed to embody. The values were not complicated. They were, in fact, the values that any honest service provider should hold: transparency about what you are offering and what it will cost, alignment between your interests and the interests of the people you are serving, and honesty about what you can and cannot reliably deliver. These values, so basic that stating them seems almost redundant, had been absent from large parts of the investment industry for most of its existence. Bogle made their absence visible, built an institution that embodied them structurally, and argued for them with enough consistency and enough evidence that the rest of the industry was eventually forced, partly by conviction and partly by competition, to move toward them. The revolution of simplicity, as it might be called, is not quite complete. Active management persists. High fees persist in some corners of the market. The behavioral errors that prevent investors from capturing the full benefit of low-cost index investing persist in the gap between what funds return and what investors actually earn. The concentration of the passive industry in a small number of enormous providers raises governance questions that have not been fully resolved. The expansion of the exchange-traded fund universe into complex and unsuitable products continues to create risks for investors who do not understand the difference between a simple total market index fund and a leveraged inverse sector fund that happens to share the same structural format. But the direction is clear, and it is irreversible. The idea that simplicity, practiced patiently and at low cost, is a superior long-term investment strategy for the vast majority of investors. This idea has won its argument. It has won it in the academic literature, in the institutional investment world, in the behavior of the retail market, and in the competitive dynamics of the fund industry. It has won it not just in America, but increasingly in every developed market where the index fund concept has spread. And it has won it in the most meaningful arena of all, in the actual outcomes of actual investors whose retirement accounts and college savings and financial futures are measurably better for the existence of what John Bogle built in his Spartan office in Valley Forge, Pennsylvania, nearly half a century ago. There is something worth sitting with in the quiet of this late hour, something about what this whole story, from the academic offices where Farmer built his models to the trading floor, where the spider's first shares changed hands, to the phone in your pocket through which you can buy a piece of the entire American economy for the cost of a single share, what this whole story says about the relationship between simplicity and wisdom. We live in a world that systematically overvalues complexity. We pay more for things that are complicated, that require expertise to understand, that come packaged in language that signals sophistication and depth. We are culturally primed to believe that more analysis, more sophistication, more active intervention will produce better outcomes than less. The index fund revolution is, among other things, a very long and very well documented argument against this presumption. Not in all domains. Complexity is genuinely useful in many contexts, but in this specific one, where the evidence has been assembled with great care over many decades. Here, the simpler thing won, the cheaper thing won, the more humble thing won. That is a remarkable fact about the world, and a quietly reassuring one. It suggests that in at least some of the domains that matter most to ordinary people's lives, the path to good outcomes does not require extraordinary expertise or exceptional resources or the ability to outsmart everyone else in the room. It requires patience, consistency, low costs, and the willingness to accept that the market in aggregate knows more than any individual participant. It requires above all the discipline to do less, to resist the temptation to react, to trade, to seek the exciting story and the exceptional manager, and to trust instead the slow, invisible, compounding power of simply owning everything and waiting. Own the haystack, stay the course, let time do its work. These are not complicated instructions, They do not require a finance degree or a Bloomberg terminal or a subscription to any research service. They require only the kind of quiet conviction that comes from understanding, at a deep enough level, why the simple approach works, and the kind of temperamental steadiness that allows you to hold that conviction through the market's inevitable turbulence without abandoning it in favour of something that feels more like control. That understanding and that steadiness are what this whole long story has been building toward. The academic evidence, the biographical portrait of Bogle, the decades of patient persistence, the two crashes, the fee war, the democratization, all of it points toward the same conclusion, stated in the same simple terms that Bogle used in his Princeton thesis in 1951, and never saw any reason to revise in the 68 years that followed. The market is hard to beat. Costs matter enormously. The simple, low-cost approach will serve most investors better than the complex, expensive one, and the sooner an investor understands this and acts on it, the better their outcome is likely to be. Rest now. The argument is complete. The story has arrived where it was always going, and somewhere out there, in the quiet architecture of the financial system, the index funds are doing what they do, holding everything, charging almost nothing, compounding with the patient indifference of a force that does not need anyone's attention to continue its work. Sleep well. The market will take care of itself. It always has. And so, we've travelled together through one of the quietest and most consequential stories in the long history of human enterprise. We walk through the confident world of the stock pickers and the star managers, through the university offices where careful people assembled careful evidence, through the life of a man who was knocked down and built something lasting from the fall. We witnessed two crashes that taught what decades of data had not quite managed to teach. We watched a simple idea, mocked and dismissed and persistently ignored, become the foundation on which millions of ordinary lives are quietly built. What stays with you, if anything stays, need not be a fact or a figure. Let it be something softer than that. Let it be the feeling of what patience looks like when it is practiced without recognition, the feeling of what humility looks like when it is chosen rather than imposed, the feeling of what it means to trust a slow and invisible process, to resist the noise, to own everything and wait. You're part of that ongoing story tonight. Your small participation in the great collective enterprise of human economic life is real, and it matters, and it does not require your attention to continue its work while you sleep. So let go now, let the numbers dissolve, let the markets close, let the long day finally, gently release you. You have done enough. Rest now. Good night.